Hello everyone.
Hello, sir.
Hello, sir.
Hi. Hi. I hope everyone is doing good.
Good, sir.
Yes, sir.
So
How are you, sir?
yeah, I'm fine too. Thank you. Okay, so I see um, as of now there are 7 people joining meeting. Chunky is there, Jay, Ashwath, Kanika, Nishant, Rahul, Shivam, right? So maybe we can wait a couple of minutes before we start. Okay, so today we have got a refresher session, so that would be covering all the topics that we have done so far. And because you need to be ready with your first mock, right? So the first mock would be done once we are through with the derivative class. So we are left with the derivative section only. So the two class left, one is the option, another is the swap class, and thereafter the level 1 mock would be there. But assume like there are few people who joined late this particular session, in terms of they did not join from the beginning. So therefore they wanted to have a session which covers all the items that we have already gone through. So in today's session we would be covering all those topics that we have already covered earlier, and it would be kind of a revision, but I want it is to more come from your side than me driving it, because what I understand now, you would be comfortable, especially people who already have some background in the finance and all, so they would be definitely comfortable with the terms and all those things that we have covered in the four to five chapters that we have done. So it is financial market, then your equity, then fixed income, then money market, and also part of derivative, you can say, that was based on your forward and future, right? So these uh, topics we're going to cover, and given we need to cover all of them in today's class only, so we need to be a bit quick also. We cannot just be as in stick to one of the chapter, rather we need to cover all the 4 or 5 chapter that we have already done earlier. Okay, so let me just see how many people have come. Still the same number of people I can see. So let us wait for 2-3 more minutes, and then we will
I have
kick
a
off.
question regarding the options. So
Yeah,
should I
Nishant.
ask after the class or
No, you can ask now, because because at this point the less people are there, so we can cover the question. We can take your
so, sir?
question.
For that, I required to share the screen. So can you give me the permission?
Yeah, yeah. Go ahead.
Thank you.
Uh, yeah.
So is my screen visible?
Yes, it is visible.
So, sir, this is the chart for Bank Nifty for 4th of June. So we
Fourth
can
of
see a
okay.
4th of June, yes, sir. So we can see a bearish trend over here,
Yeah.
and so that's what if there is a bearish trend, so the call should be in the bearish mode also. Am I
Hmm.
right now, sir?
Yeah.
So
Right.
if you see this one, the 37,000 call, it's a bearish, which is
Yes.
absolutely fine. And
Hmm.
if we see the put option, it should be reverse of that, as in it should be bullish.
Hmm.
So it's also fine over in 34,900. But if
Okay.
we go deep in the put option,
Uh,
like in as in 34,000,
uh,
the trends seems to be on a constant mode. And if we go much deeper, like 33,000, it's going downwards, as in it should go upward, but why is it going downwards?
Okay, so, though I've not as in gone through these charts at my end, but looking at the chart that you're showing me, right? So possibly, as in there could be two reasons. So those trends which we see, one is the near term, and as in the trend which is appearing with the current moves or the current trades which are made by the traders, and one could be the trades which were already taken by the traders. They are still continuing, and they are still keeping those trades, hoping things to work that way, right? There could be two things. So options, option chain, when you look at, there could be previous trades also, and there could be unwinding also, and then there could be new trades opening up. So the two things could be there. So basis the trend that you're showing, like, so trend is depicting the time when it was reacting, that very moment when the thing happened. So these two charts, rather you showed me three charts, right? So these three charts are for 4th of June, or they are for previous dates? 4th of June,
These
right?
are for 10th of June. That's why I took it for 10th of June.
Okay,
The
10th of
expiry date,
June.
na? Yes, sir.
Okay. Okay, you're saying the expiry you have taken. Basis the expiry, you're trying to gauge how it is looking like, right? This is what you're
Yes,
saying,
sir.
right?
Yeah.
Okay, so this, so then I can probably say like this is more basis on the previous trades and all. That is what I can make out. Like, so there is a recent trend which is coming with the recent move which has happened in the market, the last 2 days move, right? So basis that it is kind of reflecting the option chain for 10th of June, and there are some previous moves also. So it is mix of both, you can say. So at the one side it is showing that is a deep side, so you're showing still the people have got a different view, but in the recent view, so that it looks like the people have made a different directional trades have been taken by the people. So that is how, as an, at times it's
So
not
as
very,
we can
yeah,
also see in this option chain, na, the data we
yeah.
can see the put. If we see the put data, the
Uh-huh.
out of the money puts are also decreasing. The change is
Decreasing.
also in a negative trend.
Mm.
I can't understand why is it that, because since market is on a downward trend, these out of the money put option should increase now.
Mm. Let me just have a look. Mm. So if I look at this, uh, so where you see the data is it's different, as in which one? Maybe you
The
can just.
at 34,900, at
Mm.
34,900 we can see at put we can see a point 0.1 change, a positive
Uh,
change, but at 34,800 we see a minus 5.6 rupees change. Why is that? As in the market is bully is bearish, so these put options should increase now.
okay. Okay. So, and when I look at your the volume wise, right? So when you look at the volumes, what is, when is the maximum volume? 8 lakh is one this, right? And then 4 lakh is there, right? So it is giving, it's not giving us as in one way view. It is giving mix of both. What I can see. So there is one side, it is positive also, right? And the sum of the trades have been unbound also. So that is the reason, like, so you cannot fully rely on the option chain data also, because now people make different uh, it's not always completely the same picture all the time. It may have a different view also. So why this is what it is appearing on the option chain also, like, you're true, I get your point what you're trying to say here. But but that's the reason we say the option chain is not, you can never say like basis the option chain you can have a proper view of the market, not like this. So the market only can probably depict part of it in the option chain, or may not be depicting completely what is there on the ground in the market. So that is how the option chain is all the time. So you should not be relying it completely with this opinion, like it is going to be that way as the option chain is telling you. No, it is not, never like that. It is just the people who are making trade. It is you and me only, right? It's like
Mm-hmm.
you and me who are taking, and there would be many people who would not be even relying on the charts and all. They're just taking trade. You're just taking. There are many people. I'll tell you. There are, or rather, I would say, 50% of population is such who are taking trade basis the advice of their broker, basis the advice of the friend and family member who are doing trading and all. So they are not they're not going with the charts and all. So there are some seasoned people like maybe you who do regular trading, so who look at the chart and everything, right? So that is how, that's the reason why it is not absolutely matching the expectation that we are thinking. Like, so if it is, so that's what is reflecting there. So change that you're saying,
Okay.
yeah.
Sir,
So
in
that,
this chart, as I can see,
yeah.
there is lot of put writing in 35,000 option. So
Hmm.
maybe now currently Bank Nifty is in 35,200. So
35,200,
it
yeah.
is say that means those who have 35,000 put option, they are
Hmm.
already in 200 rupees loss in the spot market. So once the means if the Bank Nifty rise again, means it goes up to 35,500. So it
Hmm.
may be possible that the 8 lakh volume in the 35,000 put option, they may be unwinding their position. So it may
Hmm.
be helpful in rising the market. It may be one of the means outcome from this chart also. And
Hmm.
also open interest is higher in put side. So maybe it is most likely the resistance will be happen in the higher stage. Means we
Hmm.
can derive some kind of thing from the options and also.
Hmm. Yeah, yeah, that's true. So on the other side, when you look at the call side, right?
Mm-hmm.
Or when you look at the call side, right? So change is on
Very
300, 800, right? So change is 2200.85. So, and it is up till, so largely I would say if you look at two sides, call and put, so it is a bullish view only which is trying
Mm-hmm.
to is coming, because at the call side also a lot of change is coming and the call is just moving up and up, right?
yes.
So it is, it is, so I understand what you're trying to say, like on the put side it is not giving the exact same picture which you try to get from the call side and the put side, right? So if some one side is giving the bullish signal, then other should be giving the bearish signal. That is what you're saying, right? So maybe
Yes.
it does not resonate truly with the option change, or you can say with the data at times. And it is broadly with the, I'm telling you, with the mindsets only, because there are a lot of people who are doing traded just randomly. They have learned certain things and then they are doing trading, so everything would not resonate very same as you might be able to see on the chart, on the intraday chart, or maybe the chart which is there for as in the option chart also. So so that is the main reason I would say. But still I can probably check
Okay.
at my end, try to find some more information. If there is, then we can accordingly share that with you.
Might
So, okay.
yes.
Yeah, go ahead.
Yes, you can do.
Yeah, go ahead with.
Yeah, sir. On fourth, I took a trade at this point,
Okay.
35,200,
Okay.
and since it was a bearish trend, I take my chances because RSI was
Uh-huh.
oversold. So, uh, was it a correct trade, sir? I ended up at profit, but still, I need a confirmation from your end. Uh, is it a
Okay.
strategy that I can rely upon, that RSI one?
Yeah, at times, but to be honest, RSI is not something which I would say is a true indicator. At times, even when your market is overbought, right? Then also market, right, it goes even beyond that overbought zone. So overbought is when it is 70 plus, right? It becomes overbought zone. But it is not always true. Like if something is overbought, especially I'll give you one particular stock, and I have mostly seen that stock in overbought zone, but even that consistently going against that RSI indicator and kept on doing good. So that is Relaxo is one stock. If you look at that stock, you would,
Mhm.
people use, they always said this is in overbought zone, don't buy it, don't buy it, but it continued. and today it is trending at 1000 plus something, right? So there, same goes for Nifty also, and Nifty Bank also for that matter. So even when the Nifty Bank is overbought zone, so there is a possibility where it can slide. It may not slide also. So that is that's the only reason, Nishan. No matter how much we rely on the chart, there are certain things which always depend on the market. So market isn't how the market read about the situation. These charts basically reflect the market only, right? How the market is has responded or going to respond. But what market is going to respond can never be predicted. If that was so easy to be predicted, then probably no one will lose money. No one would ever be having negative thoughts about the market. So that's the sad picture, or I would say the hard kind of reality. No matter how much but you can truly, one, when you're doing trading, especially intraday trading, I would say,
Mhm.
maybe the future trading I would not rely on, be it the option or all those things. I can just probably try to gauge, but I'll not rely on the data, because again, the next day how it is going, what news comes, maybe the RBI governor comes and says we are going to increase the repo rate, right?
Mhm.
So you would see that impact coming in the market for sure. If he says, though on Friday did not say something of that kind, but if he says no, now we cannot continue having the 4% as the repo rate, we need to make it 4.5 or maybe 4.25 only, right? So that will definitely will reflect, but that in given it has not come on Friday, or no one knows about it, so your chart will look like same as you're showing it. But on Monday, news come in the 9:30 or 10, so the
Yeah,
chart movement will change automatically. So no
it might
matter,
show a gap up, gap down entry as well.
yes, right. So that will change. So that's the aspect I'm telling you. But as far as this particular case is concerned, probably I can try to check it my end. We'll try to see if there is some other nuances which we are not able to find by looking at it. But your, as in when you bought it, you sold call, or
So
you bought
I
call?
got long on out of the money call
Okay.
at this point, because RSI was saying that I am overbought
Mm-hmm.
or sold, sorry. So I think it will give a bullish move, and it did give a bullish move. So yes, it
Okay.
wasn't a big profit, but yes, the trade was in a positive,
Yeah,
what
so
I have
ideally
expected.
your strategy was fine, because you actually went with the normal indicators wherein it was oversold. So oversold is, from there it is expected probably the market will move towards upside only, right? When it is
Yes, sir.
oversold, so largely it is expected the market to go up from there. So that way I would say it is not a bad move, it is a good move only. But we need to be very mindful then also when we are taking this trade, because the market sentiments and all at times may and what time did you take this trade?
I think at 2, I guess I took a trade at
Yeah,
this
so largely.
when it broke this level, I took the trade
Mhm, mhm. Okay,
because I wasn't so certain that it will break it. And
okay,
it did break, and at 3, I think I booked that profit. So
okay. So that way I
so
would say it was
that was
fine.
because, sir, yeah, that
Yeah.
was because since market is going to be in a bullish move, so the out of the money call option, the premium on those will also gonna rise. That was the mindset which
Mm.
I was trading at. So
Yeah.
it
So that
did,
was.
but it didn't give me.
Yeah,
Yes,
so
sir.
your mindset, absolutely, because if you see here there were two green signals. So you took after the first green signal, the second when it came, so that it was sort of going into the
Yes,
bullish
sir.
mode only. So that
Yes.
entry was good, I would say, but the reason it did not give you much profit, because if you look at the morning trend, even I watched Nifty Bank and Nifty also on Friday. So
Hmm.
so it was not it was quite a range bound. It was not going, not there was not a much movement happening in Nifty Bank and in Nifty also, for that matter, on Friday. So that is the reason. Earlier there was some downside which happened, right? So in the beginning, and the downside, and thereafter the upside movement did not happen much. So there was some upside
Yes,
movement which happened, but it
that was
wasn't
the
much.
concern. It,
Yeah. So that is the reason is people are very cautious about the market. It's already gone up, and now to when market continues doing good for about 2 weeks or so at the same level, as in it does not break the downside movement, right? So then the market player will get confidence that like this is a new support, and from there you will find some kind of a upside movement also. But at the moment people are very cautious and very suspicious also about this particular standing of Nifty and Nifty Bank. Where they're standing at the moment is really at the peak, you can say, kind of. And given the whole situation at the ground is quite opposite of what the Nifty and Nifty Bank are reflecting. So people really want to go slow, and that is the reason people are not, you don't see that level of movement coming in the Nifty. And that is not about just a Friday's story. Even if you look at the past 2-3 days, it is the same thing, wherein Nifty is not moving too much. So on Monday it moved, on Tuesday it moved, but now for the past 2-3 days it is consolidating kind of thing. So it is, you can say, if it continues stay here for a couple of more days or a week, so people would realize this is going to be new support, and then there would be confidence building, and probably from there it will move up, it will go up for sure, unless there is some negative news coming from either from the Asian market or from the US market, or maybe the Indian market itself. So there can be some downside also. Otherwise I see it is going upside, or maybe staying at the same level somewhere. 200 point, 300 point up and down may happen, but largely it will stay at the same kind of same zone.
Okay, sir.
Okay. Yeah, that's good.
Sir,
I'm yeah, go ahead, Akash.
sir, can you tell me the resistance level that currently the Nifty Bank is having?
I guess the current is, you can say, it is 37,000 something. But what I expect, if this, if this, which I'm, as in this, if Nifty continues to stay at the level where it is staying, as in does not move too much downside, right? There is a possibility in another few, as in a few weeks. When I say few weeks, so make it 4 weeks time, you might see Nifty moving close to 40,000, 41,000 also. So that is my
Okay.
understanding of the market. So it can move up to 40,000, and this is very true. I'm telling you because on if you look at the results of banks and all, and when I say Nifty Bank, because it is coming from the banks only. Banks largely are doing good
Yes,
as
sir.
of now. As of now. So if you look at SBI results, if you look at ICICI results, and all of those banks results, you might you might gauge the Nifty Bank is not reflecting anything untrue. It is reflecting true story only. Maybe the RBI governor has a different story to tell, because he differs from the, as in the, the ground reality and the Nifty and Nifty Bank showing that. So he might have a different view, but if you look at the Nifty Bank, it is somewhere reflecting what is happening on the ground, and at the same time there might be some of inflation in terms of inflating the value of the Nifty, I'm saying. So if that inflation even is reflected in the number of Nifty Bank or Nifty, that is become merely because people are very hopeful about banks, and that is what the commentary of various CEOs and chairmen of the banks are also saying. They are also quite hopeful about the asset quality and the loans they have given to the various entities and stakeholders. So they're positive about those NPS not having that much. So maybe not in the longer run, in the immediate future or in the future foreseeable future, you can say that those chairmen and CEOs are quite positive about those things, and that is largely the
But
reason that Nifty is doing good.
but sir, the
Yeah,
recently RBI said that the market isn't like a
true reflection.
it is not, yeah, it is not reflecting the true things, or it
Yeah.
is like a bubble. Whereas
Yeah.
in the recent interview by Rakesh Damani,
Uh-huh.
they said that, sorry, Rakesh Jhunjhunwala, they said that they are more bullish about the market. Both are
Yes.
conflicting each other. So
Yeah. Right.
according to the result that companies are posting, they
Big
are
big books
posting
are
continuously
always
profits.
very bullish
Hmm.
on the market, so we can't really rely on
Yeah.
their situation. Even though market was depleting at that time, Rakesh Jhunjhunwala said that buy more, buy more. That
Yeah.
was correct
Yeah,
notion. So that's a very different perception that we are looking at now. If a big investor, big bull investor will be look the market at a different way, but the government will be looking at a different way now.
Yes.
That might be the case.
So I would not say RBI governor is wrong. If you look at from the economic activity point of view, he is absolutely true, right? So what he's saying, the economic activity is halted, and that also reflect with the GDP number. It is 7.3% contraction in GDP, right? So that basically means economic activity has not accelerated, or it has not gone up with the same speed even now. Rather, it is halted much, I would say, because of the COVID second wave. Had there been no COVID second wave, probably we would have been better placed compared to the COVID first wave. But given due to this COVID second wave, the things have been more more gloomy, more slow, I would say, and that is the reason the economic activities have not taken pace, and that's absolutely true, which he is trying to convey to the people. But if you look at the when you look at the equity market, or for that matter the Nifty Bank or Nifty as an index, so the people who invest in these market, they do not invest just for an immediate point of view. They are looking at the larger view. So whenever you tend to show positivity, when I say the entities who are part of the Nifty or Nifty Bank, if they tend to show positivity, so there is quite a good chances people will put their money, uh, hoping it is going to be doing good. If you look at especially the banking sector, when I say banking, so banking, I'm not talking about all the banks. Largely, if I talk about the public sector bank, then SBI is one of them. Then the private sector bank, SDFC, ICICI Bank, and Axis Bank. These are the one who really do good. So they are the one who are actually driving the index. So they have got more weightage. Now SBI is not having that great weightage, but the private sector bank like SDFC, Kotak, Axis, ICICI Bank, these are the one which drive the index Nifty Bank, I would say. So they're better placed, and SBI are also at the same time complementing them. So that's the reason you can say it might not be resonating with the ground reality. It's absolutely true, but somewhere have to accept like markets, and it is not a true reflection of the economic activity happening on ground. So somewhere
But sir,
this is also effect.
yeah. But sir, as you see the last same situation where in 2002 that SARS come into the
Uh,
country. At
uh,
that time, only the reflection when the market reflect the two picture is around after 6 to 8 months.
yeah,
And in 2007 as well, the market is means if you want to check the clear picture, then it comes out not directly onto the same
yeah,
time, but after 6 to 7 months. That after when all of us thinks that the situation is good and now we can
mm,
invest, but at the same time the market goes down. From
yeah,
last 1 month, the foreign institutional investors also withdrawing the money on a continuously basis.
mm,
So this would be a one sign that it could be uh, it could be down for some time or some.
mm. Yeah, that's a very good point. That's a very good point you made, because unless you look at those numbers consistently over the years, or maybe for about a year, if not over more years, at least for a year and a half, then only you can be sure about what is the true picture. So maybe the numbers that we are seeing, the numbers which the banks are projecting, or showing to people, those numbers are not impacted uh, by the COVID and all, and therefore it is giving very rosy picture about banks and all. And after a year and a half, and so if that does not stand same, which is standing at this moment, then it might be a different story altogether. I agree with this thing. So bank, if they
So
are expecting like they continue to have a good asset quality and all those, and the bank also changed their view. They have made this view today. Maybe after 3 months or maybe another 6 months, they can change the view. So that's another negative, I would say. Maybe we are positive about the banks and all at this moment. After 6 months, if banks say no, we have got more NPAs and all, so the picture can definitely change. So that is also a good point. We cannot just rely with the one a quarter or 2 quarter numbers. We'll have to look at this story for about year and a half, and then only we can be sure about if that's the real picture or the true picture or not. So that's I agree with this point for sure.
Yes, sir. Sir, I read one news as well that in the
Mhm.
last 1 or 2 years, Federal Bank, the Central Bank of America,
Yeah.
printed huge money. That is the one of the reason that American market didn't fall. So,
Mm.
is it true or is it just a rumor?
I'm not sure about the printing of notes, but that is one thing is very sure. They have really come given a lot of liquidity in the market. That is sure. Like the package they have given, this $1 trillion package announced twice by the US government. So looking from that point of view, maybe they have done a printing of notes also, but I'm not very sure about this particular thing, if the printing has really taken place or not. At the moment, Indian government have also not done printing, but some of the participants in the as in this government are also suggesting like Indian government might have to go for printing note if in case things do not stand good for India. So, but printing note is a very tough decision. It's a decision which is taken only when there is nothing else left. So then only the government can go and print notes and all, right? So it's a good discussion that we are doing. We are reading about the market and all, and keep doing this because one, it gives you more information and awareness about the market. At the same time, you have it shows you in a good side that you are very relevant in terms of the market information and the general awareness. So I appreciate that. Great, guys.
Thank you.
Okay, so today's agenda, I can see a lot of people joining now. I guess we are all, it's a full house now. So let me share my screen. Okay, so we will be doing revision for all those chapters that we have covered earlier. And this is going to be very quick. So we need to complete all the 4 5 chapters that we have done so far. And as I was telling in the beginning, for people who join late, so you would be having your level 1 mock after completion of your derivative chapter. So we are left with two chapters in derivative. One is option, another is your SOP. So thereafter there would be a mock. So the reason I'm giving you heads up now, because you would be given on a week's time. Once this derivative is completed, so you can start preparing from today onwards only. Don't wait for that week when it is announced that you are going to have a mock. So start preparing from today onwards, so that you have ample time for the preparation, and accordingly you can be ready for level 1 mock. So let's start with financial market. What all things that we covered in the financial market? What is the features of financial market? What features you remember of the financial market? Anyone?
Sir, it is a physically located market and virtually a online market.
Yeah, you can talk about both of them. So physical. Let's start with the physical one. Yeah. So when you look at the physical market, so what features come to your mind? What are the features for the physical market, which make this market really a good market? Okay. So just to maybe give you a hint, so you might remember we talked about financial market provides a lot of things. So it provides liquidity, it provides price discovery, it provides enough volumes, right, and cost reduction of transaction cost. It provides a guarantee for settlement, and it provides strong regulation for investor confidence.
Even it is easily accessible, and even the government controls these things, so there is a lack of transparency associated with it.
Yes, right. So yeah, right. So these are the feature you can say broadly. So just to name them again, one is your price discovery is available. Another is liquidity is available. Then because of having this financial market, you see the cost reduction is there. Transaction cost reduction is also there. Then you have a regulator who is ensuring strong regulation, strong strong investor protection rules, or then you have a guarantee of settlement. So these are broadly few of few of the features of the financial market, right? Right? Clear? Anyone has any doubt? Okay, what is direct finance, indirect finance? Anyone? So these are
Finance involves the participation of an intermediary, whereas there is no intermediary in an indirect finance.
okay, right.
Maybe
Good
there's a
point.
presence of an exchange, there is a presence of somebody who's controlling regulation is there.
Yes. So that's right. So the where there is no intermediary, that is called your direct finance, and when there is an intermediary, that is called indirect finance. So you can probably, if you want to call with an example, IPO would be your indirect finance, or that would be a direct finance. IPO activity.
It's a direct finance.
Indirect.
That is your indirect finance, right? Okay. Yeah, that's an indirect finance, right? Okay. And if a private investor investing in a company directly, will that be called a direct finance or indirect finance?
It will be
Direct
a direct
finance.
sale.
That's direct finance, right? So you as a promoter, or you take an approval from the shareholder, and you give a part of a stake to a direct player, as a private player. So that is called your direct finance. Like in case of Reliance Industry, last year you remember a lot of players took stake in Reliance Industry. So that is your direct finance, right? So okay, anyone who's new apart from Shreya? Shreya, I guess you have not covered these topics. Anyone else who has not covered financial market or other any of these topics, equity, fixed income, money market? Anyone? All other have done, right? Amit, your voice is not clear. Maybe is it only me who is not able to, or is it
Even I cannot hear what Amit is saying.
okay? So Amit, some issue with your I think net. Okay, fine. Okay, let's move on quickly. Maybe you can. So this we have already covered. So I'll not. I'll let's stop here. I think. Yeah. Yeah. Go ahead.
In the official market where they know implement is called direct financial.
I am sorry. I'm still not able to hear your voice. Maybe if you want to, maybe because you can post your question in the chat box. I will try to answer while looking at there. So while you look at the structure of financial system, right? So this is how there are financial market, financial participants, financial services, financial regulator, and financial instruments, right? So that is how your financial markets are divided. Okay. So let's move on. So just to give you the same information in another form, these are your financial participants. Then financial market will see on the other slide, and the financial instrument will cover in a subsequent slide, and financial regulator, financial services accordingly. So these all are your financial participants. Investment bank, retail bank, corporate bank. What is the difference between investment bank and commercial bank? I hope everyone is clear.
Yes, sir. So investment banks do not accept deposit from the public.
Yes, right. Yeah.
Investment bank deals with raising of funds like IPO releasing and all. And basically, retail banks deal with this lending, SME lending, MSME lending, and all these things.
Right.
Investment banks are into advisory.
Yeah, they are into advisory, right? They are into research, they are into trading, they are uh, into stock lending and borrowing. They are into
M&A.
uh, yeah, M&A, yeah. M&A is merger and acquisition, right? So these are the services which are dealt by investment bank. While you look at commercial bank or retail bank, you can term them. So they are into consumer side of the business, which is your deposit and loans. So that's the primary core business which they have. One side they take deposit, other side they sanction loans to their customers, and other than
How
that
is,
they also, yeah.
how is an investment bank different from a development bank?
What are you saying?
I'm saying, how is an investment bank different from a development bank?
Okay, so development bank is a different in a sense, these have a government backing. So because when you say development bank, like IDBI is one of them, right? So they usually in India, so they usually have a backing from the government, and their objective is to develop the infrastructure and help the enterprises who are having a broader view of developing the economy. So that is how the development banks are created. So their objective is to develop the infrastructure or develop the economy at large. So and they usually have a backing of the government. However, investment banks are broadly focused on creating the wealth and the wealth for their customers or their investors. So that is the broad and fundamental difference between your development bank and your investment bank. Making sense, Anna?
Yes, sir.
Okay. I see. I guess Amit has posted. Okay, Paras is there. No problem, Paras. It's all right. Okay, no worries. So I hope you're connected now. You can listen to me, right? Okay, and what is the difference between mutual fund and hedge fund?
So hedge funds are less regulated.
Yeah, mutual fund is regulated. One someone said, okay, fine.
Yeah. Hedge funds are for HNI investors.
Yeah, hedge fund is for HNI investor. Anyone else want to add?
Hedge fund is likely
In
to
a
protect the risk, protect the loss. Hedge fund is there, and mutual fund is generally a growth type of fund where I mean a pool of money invested in security to gain the growth or profit. The hedge fund is to protect the loss.
Okay. Anyone else want to add? Maybe you can repeat also. Don't worry about it.
sir,
If
in
you,
case of
yeah, go ahead.
in case of hedge fund, uh, they are already they are mostly invested by HNIs, and in this case, we don't know where the funds are invested
Okay.
and in which security the funds are invested. In case of hedge funds, but in case of mutual fund, we know the how the funds are to be allocated and in which proportion they are allocated. So
Right.
between
Very good.
mutual fund and a hedge fund.
Right.
And
Well
so the
said.
minimum limit to invest in hedge fund is like, I guess, 5 crore, and in mutual fund it can be as low as 500. But I'm not sure about the hedge fund. It is like 5 crore to approximate. The person should invest at least 5 crore to invest in the hedge fund. So
Yes, it is. It is quite a big money, and it is 5 crore or 1 crore. I guess number is 1
Yes, sir.
crore.
I'm also confused between 1 and 5 crore, sir.
Yeah, it's 1 crore for Indian, and for your US customer, it should be somewhere 300,000 USD to $1 million. So that is the, as in somewhere between this range only, you should have a money of about 300,000 USD to $1 million. Then you can probably go for a hedge fund investment. So they only entertain such investors who have got this large chunk of money. So very well said. Anyone else want to add or say something more about hedge fund or mutual fund before we move on to other?
So I think in hedge funds, the hedge fund manager might have to achieve some waterfall returns or
Yes,
benchmark, I reckon.
yes, absolutely. So hedge fund usually have a very high target for their customers, and that is the reason they always entertain customers who have got a huge investment to invest. So they do not entertain any normal layman. They only cater to the sophisticated investors. When I say sophisticated investor, who really have an understanding about risk and reward associated with hedge fund investment. So that's one. And apart from this, when you talk about reward and the risk, the reward and risk are really high in hedge fund. Given the investment made in hedge fund can go anywhere and in anything and everything, you can say that way. So even people who are investing their money in hedge fund would not be aware about where the money is being put. So it is the fund manager say responsibility to put it in such a way so that they can have maximum returns for their customers. And there is a particular concept in hedge fund wherein they also take a 20% profit on the promised profit if it exceeds the returns agreed with the customer. So when I say exceeds, assume I commit to you 25% return, and I give you more than 25%, say 40%. So on the 15% surplus which I have created for you, so on that 15% surplus, I would also be taking 20% of that money. So that 20% would be mine, and rest would be 80% would be yours on the surplus profit which I generate for you. So that's a deal which is done between the investor and the hedge fund whenever the hedge fund investment is done. So, however, when you look at the other way, the mutual fund, there is no such thing. Even if the fund manager exceeds the promised return which is mentioned in the prospectus of the hedge fund. So, sorry, mutual fund. So, mutual fund also have a prospectus. Whenever they go live with the word called NFO, that is new fund offer. You might have heard this term. So in the
Yeah.
new fund offer, when it comes, they actually roll out a prospectus. The prospectus tells about every information, everything about the mutual fund, how the investment would be made, where they would be investing, what part would be into equity, what part would be into debt. That is all would be explained in the prospectus by the asset management company. So on those lines, the investment would be made by the fund manager, but there would not be this concept of 20% profit, 20% profit sharing when you are exceeding the returns for your customers. So maybe the maybe the as in the expected or desired return for customer is about 15%, and if they exceed to it, they make it 25%. They're not going to share any of the profit which is made for the customer. So they're just going to be stick with the management fee only. So management fee is there in mutual fund also. Management fee is also in hedge fund. So hedge fund is a risky investment as it caters to only one sophisticated investor who understand the risk and reward. And you must have seen hedge fund never advertise anywhere. They're not allowed to advertise like mutual fund. Mutual fund advertisement you have seen every now and then on television, but you might not have seen any of the hedge fund advertising. Why? Because it is meant only for seasoned or experienced, or you can say sophisticated investors who understand the reward and risk attached with hedge fund. Hedge fund can invest in anything. When I say they can invest in IPL, they can invest in infrastructure project, they can invest in in cryptocurrency and all. So everywhere they can invest. So that is how the hedge fund are. Wherever they see a merit in investing, they go and invest there. And anyone remember any hedge fund in India? Any name you remember? No, I can't. I can't hear. Yeah, go ahead. I'm sorry, I cannot hear you. Can anyone hear him?
Awesome.
Okay, maybe some issue. Akash, maybe some issue with the connectivity. So okay, let's move on. So hedge fund, mutual fund is clear, right? So then stock exchange. I hope everyone understands stock exchange. So NSE, BSE are stock exchanges only. Government, you understand depositories. So what are depositories? Anyone? What is their role? Why they are there?
I think they help in the
They are
paperwork.
kind of record
Depository,
keepers.
Yeah, go ahead. One by one.
okay, depository are like in India they are like NSDL and CDSL. They mostly do the register and transfer of the security, while they keep the record of who is the means actual owner of the equity, and they transfer the means, securities from one account to another account who is actual owner, and they carry on means transfer of security at the time of IPO, and in secondary market also they do the same thing, like while someone is selling and someone is purchasing, he work as means transferring from seller's account to the buyer account.
Yeah, right.
And even the what we say, if the broker went bankrupt, your shares are still safe.
Yeah, yeah, right. Absolutely. Yeah, I guess some Shivani wanted to add something, right? Shivani,
No,
go
I
ahead.
don't. No, I didn't wanted to add something. My answer was quite similar to the Ajay's one. So they keep records of the securities which are outstanding in the financial market. So this is what I wanted to say.
Okay, fair enough. Okay, so we're done with depository, right? Everyone clear with depository? So they are keeping a record of all the securities which are floating in market, as in who all are the owner of those securities, and whenever the buy and sell of those security takes place, so that means the ownership is being changing. So that is when the depository play their role, and they change change the records at their side also whenever the buy and sell of securities take place in the secondary market. Right, everyone clear? I hope. Let's move on. So insurance, pension company, registrar. Who are registrar? What are their roles? Anyone?
Registrar is the one who performs the admin work.
Okay.
Hello.
Yeah, go ahead. Go ahead, Akash. I can hear you.
Yeah, in case of IPO, when the investor put their money to invest in our IPO, then the registrar is the one who done the admin work, like Carvi or so.
Yes.
These are some registrar.
Right.
So that's all that I can.
They also create allotment form, application form for the IPO.
Yes. So they are involved in the IPO process, like the Carvey and Inam registrar, right? Link in time. The few name that we discussed while we were doing the IPO process, right? So they are involved in the admin work in case of IPO process, and their role is to ensure the allocation of the shares later on. First is the application. When the application is coming to them, it is maintained, it is kept in a proper manner, and then when the allocation of the share is to take place, they do a proper reconciliation, as in who bought them, who was the real owner, and accordingly those shares should be shifted and moved to the demat account of those people who own them, and thereafter the money is moved to the issuer. The money which is collected on the back of the IPO, that moves to the issuer who raised that money. So that's the fundamental broad role they play, uh, registrar in the financial market, right? What are the clearing houses? anyone, if in case you're not clear, any one of you, don't hesitate, just ask your questions, because maybe I'm not able to name every one of you, but you just ask your question, right? Especially Shreya, because you are
So
new. I guess for you, it is the first time that we are doing all these things. So you can definitely come and ask your questions, right? Yeah, yeah, go ahead, Akash.
Yes, sir. You asked about clearing house.
Yes.
Clearing house is like NSC and BSC.
Hmm.
According to me, because they maintain the security and transfer the security between the investor to investor, and they
Okay.
also keep track the record as well, that a number of shares to each uh, investor
Yeah.
having number of shares, or
Hmm.
at what price they are having. They kept all the detail as well.
Okay.
They also facilitate the.
Clearinghouse.
Ajay,
Yeah,
you can go
continue.
ahead.
Yeah, go ahead.
Okay. Okay. Clearinghouse mostly is the mediator between
Yeah.
sure that the buyer gets the share he wants and seller
Hmm.
gets the money from the buyer. It's like the mediator between both.
Okay. Right. Fine. So clearing house come into the picture when your trading takes place in the secondary market, like once the security is listed on exchange. So now the same security, the equity security for that matter, is being traded in the stock exchange, right? So when it is being traded on stock exchange, so you put your order on the stock exchange, right? And that order matches. So you say you buy 10 securities of ICC Bank. So that's the order that you put in. You maybe also put in the price at which you want to buy those securities. And once your order is matched with the sellers at the other side, so that means you are going to receive the delivery of those securities. And then to ensure the delivery of those security, who is going to give that, as in who would be ensuring that that thing, the clearing house is going to give that assurity to the investors who are trading on stock exchange, that your security will be delivered to you. So that is when the clearing house actually pitch in, and they own this responsibility of settling the trade. So you can say the clearing house is working hand in hand with exchange. Once order is placed and executed on exchange, then the clearing house will pop in and ensure the trade is settled properly. So that's the role they're playing. They ensure the guarantee of settlement. So when we talked about feature of financial market, we also talk a guarantee of settlement. So who is giving that guarantee? Guarantee is actually coming from the clearing houses only, or the clearing corporation, you can say,
So,
right?
Just
Yeah.
one question.
sir, can you little yeah?
Sir, yeah,
Yeah.
the check clearing houses and the depository clearing houses, is this done by the same body or is it a different body? Like, clearing house also facilitate the payment of funds also, like the checks and other things also, and also promotes the facilitation of securities. So, is it
Yes.
done by the same bodies or is it a different body? If you talk about the payment
Hmm.
thing especially.
Yes, yes. So the clearing house, they have, as in they tie up with banks at one side, and at the other side they regularly communicate with depositories also, because when a trade is being settling, so you require money payment at the one side, at the other side you require securities, so that it can be exchanged appropriately with the investors involved on those trading, right? So clearing house is doing both the tasks, you can say. So they are communicating both the stakeholders. One is the depository, other uh, is your banks and all, who are responsible for ensuring the release of payment on time, right? Hope it is making sense.
Yes, sir. Got it.
Okay, great. Who are okay? Now coming to broker and dealer. What is the fundamental difference between broker and dealer, and what are their role? Yeah.
So broker is the one which deals between the investor and the custodian, or we can say the depository. They took the order from the investors and then report to the NSE and BSE and help to settle the trade between the two.
Okay.
So that is the role of a broker.
Okay, fine.
Yeah.
Okay, anyone else wants to add
So if we
anything?
simplify, they buy and sell securities for their clients, brokers.
Yes.
A broker work on behalf of the investor, and a dealer they work for themselves. Means that they execute order for themselves, and broker means on behalf of the investor.
Okay. Yeah. Right. So I hope everyone clear now. The broker who do trades on behalf of their clients, right? And dealers are the one who do trades on behalf of their company or their firm. So that's the broad difference between broker and dealer. You might have heard these two words interchangeably, broker and dealer, but there is a slight difference. Brokers do trades on behalf of their client, and dealers do trade on behalf of their firm or the company. So that is how they're different, right? Okay, now coming to custodian.
Sir,
Yeah,
sir, can I ask one question?
yeah, go ahead,
Sir,
Akash.
I'm little bit confused about three terms, that is clearinghouse, custodian, and depositories.
Okay.
So can you just explain these three terms?
Yes, of course.
I
So you
know,
say,
yeah.
yeah, one is clearinghouse, broker, and then custodian, right?
Yeah. No, sir, clearinghouse, depositories, and custodian.
Okay. So so when you look at clearinghouse, so clearinghouse is involved in the settlement of trade. So when I say settlement of trade, that means they are, once the order is placed and matched on exchange, so that is when their role begins. So they need to ensure the settlement of trade happens. So whatever the trade has happened, so that is when they are going to play their role. So they would be communicating with depository for sure, because the securities would be released by the depository post the consent of the broker and all who are involved into it. But don't go deep into it. Just understand, clearinghouse are the ones who are involved in settlement of trade. So they are the clearing houses. They are involved in settlement trade is for the clearing house. And when you look at depository, depository is a body which keeps record of all the securities, and who owns those securities. That is what is recorded. So this is kind of a record keeping body which is keeping record of all the securities floating in the market. They need to have that record in their books. So it is all digital. It's not manual record, it's all digital. But whenever there's a buy and sell takes place, so when I am holding a security, I'm selling those security, that means I'm losing the ownership of those security and it is going in someone else's name. So that is when the depository will change the name of securities in their records also. So that is the role of the depository, which depository is playing, right? And while looking at the custodians, so custodians are the one who is keeping the custody of asset. So when I say asset, means it can be your cash, it can be your securities, it can be, so physical asset we are talking about. So physical and digital both you can say. So that is how we say custodian. So custodian are the one who is actually having the custody of asset. It is also possible wherein there is a body which is playing both the roles, especially in the OTC world. There are agencies like Euroclear, Clearstream. These names you might have heard. Just make a note of these names: Euroclear, Clearstream. These are big institutions which play both the roles, custodian role as well as depository role. So there is a possibility wherein one entity is playing both roles, depository's role and as well as custodian's role. So custodian is primarily when the asset is held by that particular financial institution. That is when you would be calling that financial institution as a custodian, right? So custodians are always needed. Whenever you buy a mutual fund, there needs to be a separate custodian. Mutual fund asset management cannot have its own custodian. They need to have a third party custodian who can ensure there is no manipulation of buying and selling of the security. So the certain
So,
rules
sir,
whenever, yeah, go ahead.
if we put into a chain, so we can say that The clear depositor is one who is making the records
Hmm.
of the transaction that is happening. Clearing house is one who settled the trade,
Hmm.
and the custodian is one who is holding the
Sure.
securities.
Right. You can
So
say.
the clearing house is basically NSC and VSC. The
No. Clearing Corporation of India is your clearing house. So Indian Clearing Corporation is the clearing corporation, right? So with that, there could be a membership given to the brokers also who can play the clearing member role, like depository agents we have who can open a depository account for you. Similarly, the clearing corporation of India, that would be the main clearing house uh, on exchange, that would be giving some membership to the other brokers because the security would be traded on behalf of with the help of them. So that is how you can say the clearing house is there. Clearing houses are not exchange. You would say exchange are separate entity. NSC, BSC, they have got this. They are this separate entity. You can say it is another extension of exchange that is known as a clearing corporation, but that's a separate entity which is there working hand in hand with the exchange to ensure the settlement of trades. You can say that way.
okay. So in case of custodian, so custodian was one who is having the security, and you
Yes,
said that the financial institution is the custodian.
yes,
But
right.
as an investor, I have the security, I have the shares of a particular company. Then
Mm.
can I be called to be the custodian or not? If I bought some shares for a particular company and I having the shares of that company, then I am becoming the custodian of that company or not? I am audible, sir. Hello, hello, hello. Hello, hello.
Sir is not in the group, I think. I mean, he's not in the participant list.
Hello,
As you are audible, but sir is not in the meeting,
Sir
I
is
guess.
not there.
hello. So I'm audible.
Akash, sir is not there in the.
Okay, okay, okay.
Yeah.
Okay, sorry guys. So I guess I was dropped from the meeting because of my laptop getting shut down all of a sudden. Though I usually receive a pop-up, this time I did not receive a pop-up. It was shut down. So what were you talking? I was There was a question, right? You were asking some question. Can you hear me?
Yes, sir, we can
Yes,
hear
sir.
you.
Okay, okay. So
Yes,
I
sir.
okay. So you were asking about broker, right? Clearing house or broker, right? Custodian, right? Or that
Sir,
is answer.
sir, I have a question that you told us that a
Yes,
custodian is the one who is holding the security, and you
yes, right,
gave the example that that is financial institutions who are holding the securities is the custodian.
right,
Okay,
absolutely.
so if we bought a shares of a particular company,
Hmm.
so can I be called as the custodian because I'm having the shares of a particular company?
No, your broker would be called a custodian because in your case, as a retail customer, you cannot be called a custodian, right? Because you are where you're holding a security, you're holding some security somewhere, right? So, as in you are holding, especially when you cannot just look at from the securities only. So either even the cash, right, or any kind of asset. You can also look at commodity, securities, cash, everything. So where is that is held? It is held with the broker, right? And also in case of with depository. So depository is a record keeping, as we said, and
But
apart
sir,
from depository, who's keeping safeguarding your assets? So it's a broker. So broker is kind of playing a role of custodian, but custodian as a word is more important in the OTC world, where we have a separate financial institution managing asset of institutional investors and those investments. So that is how this word is there. But for retail customer, there is no separate custodian is given who is going to manage all those affairs. It is largely the broker who is going to manage the custody of your assets and all.
in case of securities,
Yeah.
when we deal with the broker, then
Mm,
broker don't doesn't have the security. They just take the order from us and trigger the order, and the
right.
trade is settled between us and the depositories.
Yes.
And this broker is playing a role here. So in that case, the broker is not one who is having the custody of securities.
Yes. So you can say,
So
as in, if you say,
I yeah
yeah, you right,
I
saying they do not have a physical custody of your shares, right? So
yes sir.
in the retail, from the retail investor point of view, you would say the custodian services or custodian responsibility are managed by two entities. One is your broker, right, and then your depository. You can say there is no other custodian in case of retail investor, because partly in when you look at how the security is moving, when there is instruction coming from exchange, so broker act on that instruction and pass it on to a depository if it is a sell instruction. Similarly, if there is a buy instruction, so the cash would be needed, right? So who is going to act on that instruction? It is a broker who is going to debit as in act on that instruction of debiting the account. So cash is held with the broker. We agree, right? Cash is
But
held
sir,
with broker.
cash is held when we talk about the process of IPO, where
Hmm.
where we put the money for taking the IPO. Then there is some parties which comes into a contract, that is investor,
Hmm.
the bank create an escrow account where the funds are put in, and the company plus a custodian, where the company gives the share to the custodian, and custodian is one, that is BSC and NSC, where they play a role of custodian.
Uh,
They company, yeah,
you're saying NSC and BSC is playing the role of custodian?
yes sir.
No, 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 Kash, you cannot take that way. NSC and BSC are just purely the exchanges only. They are there to facilitate the trading. They are not going to play the role of custodian, because custodian as a word, when you look at, they are the one who's having the custody of asset of their investors. So in case of retail investor, like as I said, like retail investor do not have much choice. They cannot invest that huge money like the institutional investors. So especially in the mutual fund case, there are separate custodian who are going to manage the this settlement and all, and custodian are involved in settlement also. And also remember it, custodians are always involved in settlement process. So when I say debiting of account, it is done by one entity. Who is that an entity? It is broker. So broker is in case of retail uh, customer's point of view, is going to play the role of custodian. They are not having any separate custodian. It is just a broker who is entitled with this responsibility of custodian also. Why? Because they are having your cash whenever you buy. Let's suppose, take an example, you buy 10 share of ICICI Bank. So how that process will take place? You will have to have equivalent amount in your account, trading account, as
Yes,
in
sir.
for 10 shares. So that money which is there will only be debited on T plus 2. However, rather I would say T plus 1, not T plus 2. T plus 2 is actually settlement. So T plus 1 is when the amount is debited from the account. Maybe it is debited earlier from your side, because broker acts on the instruction which comes from the clearing house. So they act on that instruction and accordingly take an appropriate amount from your account, and then it is passed on to whom? It is passed on to clearing house. Clearing house keeps their account in a separate account, because they know this amount needs to be passed on to the seller of the security. So that is how this role is there. But don't just look at from the point of view of a retail customer. Custodian is a very big term, so you cannot just look at from the retail investor point of view. It is more important from the institutional investors point of view. So when you look at the mutual fund needs to have a separate custodian which is going to manage the custody of those assets, and at the same time they will be acting on the instructions of settlement whenever there would be a instruction coming from the clearing house for the settlement of those security. So it is the custodian which is assigned by the asset management company is going to be working hand in hand with the clearing house and settling those securities. So that is how it happens. So in retail investor point of view, probably you do not understand how the custodian is connected. So don't worry about it. This role is largely played by broker only, or on the other side you can also say depository or is also kind of playing the role, because they also debit securities from the demat account. So depository and broker both are playing a custodian role in the retail for the retail customer, you can say. On institutional customer we have a different setup, and in the OTC world also we have a different setup. So that is how this custodian is more relevant when you look at from the other market point of view, may not be relevant from the retail exchange market point of view. Getting the point? Hope it is making sense.
Yes, sir.
Oh, great. Okay, so let us move on. Anything else maybe you want to add, ask, or want to share?
Sir, at the end, can you please tell us the pattern of the domain mock if possible, how the mock one is going to be?
Okay, yeah, sure. I'll share. As in, you're saying how this mock would be done, right?
Yes, sir. Like what kind of questions and what all should we prepare?
Okay, so let us keep 10 minutes in the end for discussing your mock and all. Is it fine? So 3:50 we will be as in discussing about how this mock and everything would be done, right? So okay, so let's quickly move on. Okay, so when you look at from the financial market, so there are various markets that have been categorized: capital market, money market, FX market, derivative market, right? And then in the capital market section, we have got primary market, secondary market. We will be covering about IPO and the primary market more in detail in your equity, as we know. So, but now this is a revision. It would not be that detailed. We would be doing quickly only, uh, unless you have some separate questions, so we can take them in an extra class. Don't worry about it. So especially only, I guess, those people who are new might be finding it difficult, especially Shreya, I guess. So don't worry about it. If in case you don't understand here, we'll take it in some other class. So primary capital market is divided into primary market, secondary market. Everyone understand it, right? How, what is capital market, what is primary and secondary market? Anyone does not understand it, would like to explain it for Shreya? Anyone? who would like to explain what is capital market and what are primary and secondary market? Just this piece.
Try
Should I try?
Yeah, go ahead, Ajay.
Okay. Capital market, mostly the share market and stock market we used to prefer as capital market. So there is two segment. One is primary market and secondary market. In the primary market, when one unlisted company, the company which is not in stock market, want to freshly listed in the stock market, they first go through the primary market, which involve IPO process, where they mean some part of the company ownership of the company. They try to dilute to the retail investor and the outsider. So retail investor or the means most of the outsider like institution, mutual fund company that try to invest in that company for the first time. It is called IPO. And once the IPO is issued, it next traded in the stock exchange like NSE and BSE. NSE and BSE are called the secondary market, where people can resell their purchased share and all. It is happening in the secondary market. But the primary market is the fast issue time. It is primary market. Then once the first issue is done, then it is traded in the secondary market.
Fine. Anyone else?
Sir, in a capital market, basically, in a financial market, there's two type of market. One is capital market, and other is money market. In a capital market, we are investing for a longer period of time, maybe more than a year. But in case of money market, we are investing for a shorter period of time, less than 1 year. Okay. And in case of capital market, they are again divided into two parts: primary market and a secondary market. In a primary market is a one where when the company firstly come into the market and issue their shares for the subscription, like IPO. And when the subscription is done, where the next step is secondary market, where the existing securities are traded between the investors.
Right.
So again, the secondary market is divided into two market: debt market and equity market. Debt market are basically in an equity market where the shares are traded between the investors. Yeah, and in a debt market, the company issue the debentures, bonds to raise the funds.
Yeah, right. So I hope everyone is clear, like what these two markets are. One is your capital market and money market. He explained both of them. So capital market is meant for the short-term, long-term securities which are more than 1 year of maturity, right? So security which are going to have more than 1 year of a maturity, so those would be falling under capital market. And securities which have less than 1 year of a maturity, so those will fall under money market. So this is money market here, right? And then capital market is further divided into two parts: primary and secondary. So primary market is the market where when any security is listed, or when any security comes into existence, it comes through primary market only. So like you can take an example of any private company. When private company is listed on exchange like BSE and NSE, so it has to go through a process called IPO, that is called initial public offering. So that process will take place where it will take place in primary market only. Similarly, if a debt issuance needs to be done, if the government is issuing a debt, that will also be happening in primary market only. So the auction of that debt is happened. So that also takes place in primary market only. And once it is done in primary market, so you know the nature of these securities, be it equity or debt, is such they are tradable securities, right? So where they can trade in secondary market. So be it your equity or be it your debt, both can trade in secondary market. So that is how this capital market is there. Money market. So these products which are given there: T-bill, certificate of deposit, call money, notice money, commercial paper. These are your money market products which are for less than a year or within a year, you can say, right? Then we have FX market, derivative market. So these are again part of your financial market, right? So we'll talk about T-bill and all in bit later when we do a quick review of your. Okay, so now moving ahead. unless you have any question, right? So then different kind of insurance, as in products that we have, you have stock, bond, insurance, pensions, government securities, debentures. What is the difference between bond and debenture? Anyone? You in this word is always be puzzling you at times. Debenture is mentioned at times, bond is mentioned, so maybe there is any difference, or is it same?
Bonds are like a secured one, debenture are unsecured one.
Yes. Okay, fine. Anyone else apart from this? Right.
Secured as
So
in,
yeah.
the bonds have some underlying asset which can be liquidated.
Yes. Yeah. So right. So remember, so bond and debentures are such wherein bond, when you talk about bond are considered to be secured instruments. Secured, when I say secured, so that means some asset of a company would be attached with bond if it is a corporate bond, and the government gives a guarantee of bond, so that is how it is secure. So government always is there, so it is secure. Government will take the responsibility, be it by printing note, whichever way they will give the money back to you. So that is how it is secured. And on the other hand, debenture can also be secured, it cannot be secured, both way. So some of the debentures can be secured, so it will be given there in the agreement itself. So if it is mentioned it is secured, and then again the asset of the company would be attached with that. If it is not mentioned, that means it is unsecured debenture. So that is how the bond and debenture are different. Right? What are warrants? Anyone has heard about warrant before? Anyone? Not sure?
So I think they give the right but not the obligation to buy or sell a security.
Right. Okay, very good. So yeah, so warrants are like options. As we have done options, so you understand what options are. Option also given a right but no obligation. Similarly, warrants also given a right to buy some underlying security in a future date. And warrants are not traded in the exchange market, they are traded in the OTC market only. And warrant can have a longer maturity or longer horizon of execution. So warrant can even have some years of maturity also. Once issued, you can execute those warrants after a certain number of years and can avail the underlying assets uh, under those warrants. So that is how the warrants are. So warrant gives this option to the investor. They can exercise the right given under the warrant and then avail the underlying securities in the future dates. So that is what the warrants are all about. It is just like the options only, but the options, when you look at options, especially the exchange traded option, you see the options have a maturity of either 1 month, 2 months, or 3 months. In case of warrant, the number of years, as in the maturity, can be longer. It can be for certain some more years, as in maybe for 2 years, 3 years. At times it can be 5 years also. And they are the one. They are usually traded in the OTC market. They are not on exchange market. And another thing about warrant is warrant are at times issued along with the bonds also. So as an entity, when going to issue bond, so they would be issuing bond at a cheaper rate, cheaper than the market rate, and they would be giving an additional benefit to the investor in the form of warrant. So warrant would be having the underlying as equity, which they can probably execute at a later stage after a certain number of years, maybe 5 years. So they can avail equity shares also with the help of warrant. So it is kind of sweetener, which is said, which companies give to the investors when the issuance is done. So along with the bond issuance, they can offer warrants to their investors, and with the help of warrant, they can get the underlying security, which can be in the form of equity, which can be in the form of other instrument also, like debt instrument and all. So that is all about the warrant. Money market instrument, which we have discussed in the previous slide. Will not be detailing money market instrument here. Commodities, commodities like copper, gold, silver, all these are commodities only, right? So these are the regular. You have a different regulator for different markets. Stock market has a different regulator. Insurance has a different regulator. Pension fund has a different regulator, right? And banking has a different regulator, right? Similarly, across the world, there are different regulator for different markets. In USA, who is the market regulator?
It's Federal
SCC.
SEC, Security Exchange Commission.
Yeah, Securities and Exchange Commission, right? And what about UK? Who is the market regulator for UK? Not sure. PRA. PRA is Prudential Regulatory Authority in UK. So they are and FCA is also there. That is the Financial uh, Conduct Authority, FCA. So these two entities are there for the financial market regulators. And who's the banking regulator in UK and US? In
US is Federal Bank, and
Yes,
UK, I'm
yes,
not sure.
yeah. US is Federal Bank, US Federal Bank, right? And UK is your Bank of England. Like in India, it is Reserve Bank of India, right? The banking regulator. So that is how it is. Then okay, then quickly coming to what is your order-driven market and code-driven market. Okay, before that, just complete this: financial services, fund-based services, and fee-based services. So fund-based services, you can say the mutual fund, housing finance, leasing, these are all your fund-based services. And then brokering, portfolio management, advisory services will fall under your financial services. So just to these are two different kind of financial services. One can be based out of fund, so like mutual fund, pension fund, right? So these are the fund-based services. And fee-based, the wherever you're paying the fee, so that is called your fee-based services. Okay. So now coming to quickly, so this we have already discussed. I'm not going to spend time here. Uh, this we will be covering in the equity, where we are talking about the IPO process. This will be covered there. Okay. Investor, definition, who are investors. So this is regulator, we have already covered, right? This we have already discussed. Okay. So I'm not going to talk about this again. These details we have already covered. That's the reason I'm skipping it. And but still you have some question, you can probably ask me. Okay, now coming to what is your order driven and your code driven market? Anyone? I guess that
So
is there.
in a market, we only have to quote our price, but in a quote-driven market, we have to quote both price and quantity.
Yeah, in which market? Price and quantity?
In the in the order-driven market.
Right. Yeah.
Yeah, order-driven means both, and quote-driven is when the quote is when you have to just quote the price, the
Yes.
not the quantity.
Yeah. Right. Anyone else? So the code driven and order driven, anyone has any confusion? I hope everyone is clear, right? So the order driven market is your market where you have your order placed and your quantity placed. So that is your order driven market, which is basis the order, and it gives all the details of the order which are available in the market. So exchange market is called order driven market. And the quote driven market is where the quote is only given, you don't know about the order, You can't see the orders, right? So that market is called your quote driven market, where you give a quote to the investor, and basis the quote the orders are taken, and the investor does not have a visibility about those orders which are available in the market. So that is called your OTC market. So quote driven market is the OTC market, and the order driven market is also called the exchange market. Market supply demand, you already understand these terms, so I don't think I need to spend time here. These things were features of market. When I talked about, basically I meant these points only. Code driven, order driven, we have already talked here. Capital market, we have discussed what capital market is. So right, all the points that we saw in the beginning are mentioned in detail in the subsequent slides here. Secondary market, primary market is IPO that we do. Secondary market, then the equity and debt securities are traded, right? So that is how the secondary market shows the debt and equity. So all the securities which are offered in the primary market, they can further be traded in the secondary market. So IPO is an example of the primary market. We'll probably discuss about the IPO a bit more in the equity chapter, not here. So I'm just checking if something is left. Secondary market, you understand now. So largely these, okay, so when you talk about investment banks are divided into three offices. You can say one is the front office, next is middle, and next is your back office. So when someone asks you the structure of investment bank, so investment bank always function in these three offices, right? So one is your front office, another is the middle office, another is the core office. And what are the roles and responsibility of your front office? So these are the broad roles and responsibility front office plays. These are the responsibility which middle office plays, and these are the responsibility which your back office plays. Fine. Buy side. What is buy side? Sell side. Who all would be as in which all entity would be in buy side? Which all entity would be in sell side? Any idea?
Sir, investment banks are in sell side basically,
Yes. Okay.
and mutual funds are in buy side, like or pension funds.
Right. Right. So that is how it is. So your buy side entities could be your mutual fund, pension fund, because need they have money with them, and they require products for their customers or investors, right? So that is how hedge fund, mutual fund, pension fund, insurance company all will be in buy side, and the sell side would be having your investment bank and also commercial bank, I would say. So they are placed at the sell side. They have a deficit of fund, so they need fund, and on those on those funds they make product or they offer product to their buy side participants. So I'm not going to read it. You can probably read it. What is the difference between it? I've just given you. So see, asset management company, hedge fund, mutual fund, pension fund, insurance, institutional investor, retail investor. These all will be your buy side entities, and your investment bank and commercial bank is sell side. Okay. So that is largely broadly in your financial market. So financial market as a chapter is going to give you definition and the meaning about various participants involved in the financial market. So broker, dealer, custodian, depository, regulators, right, and kind of markets. So that is the high level information given there in the financial market. So that is what is expected. So feature of the financial market, difference between investment bank and commercial bank, right? Order driven, code driven market, and difference between capital market, money market, and your sell side, buy side firm. All these things are there in the financial market chapter. So you can say, so these are the few areas which you need to probably focus on when you are preparing for the financial market, so that you can probably answer questions around these topics. Clear? So moving on to your equity. So what all things which you need to remember in your equity section? First is your type of equity. So one is your common equity, another is your preferred equity. That is what first you should remember. And the type of preferred equities you should remember. And then IPO process you should remember. Then you should remember your ADR, JDR, GDR, right? And apart from that, what is authorized capital? Right, these are few things that we did in equity in your equity chapter. So just you can make a note of them. Your common equity, preferred equity, fine. Then authorized capital, and how that authorized capital is used and all. So that's one. Then you have got your IPO process that you need to uh, remember. Then you need to remember ADR, GDR, and all those things. So let's look at here. These are the four type of preferred share: cumulative, non-cumulative, redeemable, irredeemable, convertible, non-convertible, participating, and non-participating. So what are cumulative? Dividend which are not paid in the year, the company makes a loss, right? Non-cumulative preference shares do not get accumulated. Non-cumulative preference share do not get accumulated dividend. All missed dividend are not paid. Clear? Cumulative shares, non-cumulative shares. Then redeemable shares, non-redeemable shares. Shares which are redeemed by issuing company at a future date. Irredeemable preference shares are not redeemed by the issuing company. They are only paid back at the time of liquidation. Redeemable usually redeemed after 20 years. So that's the difference between these two preferred share. Then convertible, converted into the number of shares of the company common stock after a predetermined time span or a specific date. Two factors used are conversion ratio and conversion price. So this is already mentioned in the agreement. So what would be the conversion ratio of those convertible preferred share? So that would be given in the agreement when this preferred shares are rolled out to the investors. So if it is saying one preferred share is equivalent to 5, so it would be 5:1. So that means against every preferred share, you will be getting 5 equity share. So that is how this convertible share is there. And so is convertible share useful for investors? Do you really think it is a useful thing to offer to the investor, or it is not that greatly useful? What are your thoughts around it? Anyone?
It's maybe useful if the company means forecast of the company is very good, like it is going to be high, and you have a high number of shares, so you can influence the decision making also. Maybe means it depend upon the situation mostly, but I don't think it will be more beneficial as both the share price will be means getting hampered by the market situation. But in the long term, maybe it is helpful, but I don't think it will be more.
So
Okay.
convertible
Fair
shares
enough.
are easier to transfer as compared to normal preference shares, and also they can get a lot more capital appreciation on common shares as compared to preference shares. So convertible shares could be more preferred.
Hmm. Right. Yeah, that's true. Because there is an opportunity wherein if you see value in converting your preferred share into convertible share in future, so that way it may look good for investors. So investor might be of the opinion if company does well in future, so they can convert those number of preferred share into equity. So that way it can be good. And otherwise the company does not do good, then they have an option to keep it in the preferred share form and continue enjoying the dividend on the back of those preferred shares. So that is how the convertible shares give kind of a dual benefit to the investors, so they can take an advantage of both the opportunity. We either remain into uh, preferred share, right? Or they can also avail another opportunity of moving or converting uh, the number of preferred share into the equivalent number of equity share basis those conversion ratio already agreed upon, and probably own the company in the set ratio. So that is the added advantage convertible shares have got.
So,
Yeah, go ahead.
do the preference shares get capital gains on them? Does the price rise?
As in the share value you're saying? No, they would not be. As in capital gain means you can say the share value will be gaining. Uh,
That's
no. So largely these preferred share are not having that level of liquidity, because these can be traded, but they can be traded only in OTC market. Preferred shares are usually not traded in your exchange market. Right, so you can exchange preferred share with another investor who's willing to buy them, or given that like it is not driven by the huge volumes and all, so there would not be huge liquidity in preferred share, and therefore the value would not be fluctuating much. So whatever you bought it at, so that would remain largely the same value would be there for preferred share. And all preferred shares are not tradable also. There are some preferred shares which are not allowed to be not allowed to be tradable by the company itself. So that way if you are the investor, then you remain the investor as long as you do not surrender or company does not take it back. So that way you can say capital appreciation would not be there for the preferred share like the equity shares. It can only happen when you convert them to equity if that option is granted in the agreement. So that is the only way you can probably have the capital appreciation on those shares. Otherwise, the dividend is the only advantage which preferred shareholders enjoy. Right.
got it, sir.
Okay. Shreya, I hope you're getting it, because I understand that it is bit. Shreya is there or not? She left. Okay. Because she has not covered it, so I said you can also be part of the same session. I know it is a bit rush. We cannot do it the way we did it in the beginning, because you know the reason. This is a revision class, so we cannot maintain the same speed which we had in the initial class, as in the earlier class when we take it. Right. So no worries. Let's continue. Okay. So participating share, I hope you know what participating shares is and what is non-participating share. So they can also participate in the surplus dividend, and that is only when it is offered to the common shareholder. So if extra or surplus dividend is offered to the common shareholder, so the participating shareholders can also participate in the surplus dividend offered to the common shareholders. So the preferred shareholders always enjoy better dividend, which is already decided in the beginning only. That percentage is already decided in the beginning when they buy those preferred shares, right? So, but given if extra dividend or more dividend is given to the common shareholders, then all preferred shareholder cannot claim on the extra dividend, apart from if it is of the nature of participating shares, then they can claim on the extra dividend and they can also avail the extra dividend. Like the example given here, if the holders have a dividend of rupees 10, equity shareholders are paid a dividend rupees 14, then the participating preference shares are paid 10 plus 4. So they will also be claiming surplus 4, which is being given to the equity shareholders. So that is in case it is of participating share. If it is of other nature, like convertible, redeemable, and cumulative, then they cannot have this thing. They cannot claim on the extra dividend. Fine. So then advantages of preference share. Preference right is there. They have preferential right over the common shares in the event of dividend payment and liquidation. So when liquidation take place, which investors or which stakeholders get preference. So it is first is the bond holders. They get preference in case of liquidation. So their money would be paid back first. Then it is the preferred shareholders would be paid back. And the last would be common shareholders. If something is left, then it would be divided among common shareholders. Otherwise, they would be said goodbye. So fixed income, cash, or stock dividend, equity, voting rights, they can vote. So preference shareholders cannot vote in the matter of the company, but they can vote in the matter of their own interest. Okay. These are a disadvantage: no voting, fixed income, no claim over surplus, no guarantee over assets. So no claim over surplus is especially for those apart from the participating one. Difference is given there. So profit distribution, how it would be distributed: cumulative, non-cumulative, other preference stock, common stock. What is equity? I'm not going to define it. You already know it. Coming to your now share capital. So what is share capital? What we understand by share capital? So this is the capital which is in the form of shares, right? That is called your share capital. So that can be in the form of shares. So that capital is called share capital. So when company issues share capital, so they need to have an authorized capital, as in what number of shares they can issue. So that is given under authorized capital. So every company has got this authorized capital, and that basically specifies how much shares they can issue, or what is the value, as in what is the total amount for which they can issue these shares. So that is what the authorized capital. Let's take an example here. So share capital, equity plus preference share, then authorized share capital is given there, right? And then you have unissued capital and issued capital. Then you have got subscribed capital and unsubscribed capital, and then you have called up capital, paid up and unpaid up capital. So there you can say 10,000 as a number. Company says they can go and issue share for 10,000 rupees, right? And let's make a one share face value 10 rupees. So how many shares they can issue? 1,000 shares. If 10,000 is a share capital, authorized share capital, right? So if they go and issue all the shares at one go, so all would be falling under the issued capital. And if something is not issued, like if out of 1,000, if the company goes and issued only 5,500 shares, and 500 will be under unused capital. So that is how it is. Let's look at this particular example. Maybe you can better connect it. Where is that example? Okay. So authorized share capital, number of permitted shares per multiplied by par value. Par value refers to the stock value as stated in the company charter. This is also known as face value, right? So we will issue 1000 shares of rupees 10 each. That is your authorized share capital. So here as an example, you can say 10,000 is your authorized share capital. You can issue 10 rupees share. So 1000 shares can be issued in total. Okay. So it is the total share capital allocated to the shareholder, total number of share capital issued to the shareholder which may be less or equal to the authorized share capital. So total number of shares issued to the shareholder can be equal to or less than the authorized share capital. It can't be more than authorized share capital. It is the amount which the board of directors and shareholders have agreed to allocate. Issued shares are the sum of the outstanding shares and treasury shares. Shares outstanding are those issued shares which are held by the investors in the company, right? So we will issue 1000 shares of 10 each. We will issue 30 shares of 10 each. So you can see if this is the authorized share capital and if you're issuing only these many shares, so your issued share capital is only 3000 and 7000 still left. So authorized share capital is always greater than equal to issued capital. So that is how your this authorized share capital is. So
Sir, so authorized share capital also rises as the share price rises in the market.
no, no, it will not have any impact with that as in the market price of the share, because authorized share capital is just a number. Like you can say 10,000 rupees is the number, so which can be issued for shares, and you are going to assign a value to your share. So 10 rupee is the face value that you have given to the share as a face value. So you are allowed to offer only those number of shares in the market. So it has nothing to do with the market share value. It is just the one number. When the company is built, you need to assign authorized share capital as in what number of shares you are allowed or you can issue. And the authorized share capital can be changed also later. It is not, it will remain same. You can't change it. You can make certain changes in your AOA, article of association, right? And then if it is approved by the if it is approved by registrar, right, then you can change your the authorized share capital.
Okay, so that means the market price of the share is also don't have any impact on issued capital or non-issued capital also. It will
Yes,
only impact on the market capitalization of the.
right. So your market price will have no impact on your authorized share capital, neither on your issued capital also.
Okay, so issued capital will be always same. Means throughout the year, issued capital will be same.
Yeah, issued capital is like whatever number of shares you have issued. So if you
Okay,
are
let's say 30,000 share is issued out of 1 lakh share,
mm,
and par value is 10 rupees. So
okay,
3 lakh rupees will be the issued capital for a whole year.
right,
Means, let's say till next change.
right, correct. So that is how it will be. So if you have issued the example that you gave, so that will remain your issued capital as long as you don't issue more shares. Right? So that is how it will be. Subscribe, so issue capital, subscribe capital and subscribe capital is more relevant in the point of view of IPO. So when you issue your shares, right, those can be fully subscribed, those can be undersubscribed also. So if it is fully subscribed, that means all the issued capital is subscribed, fully subscribed. Something is not subscribed, that will be there in unsubscribed capital. That will again become part of your authorized share capital later, which is left as unsubscribed capital. That will go back and become the part of your authorized share capital, or you can say the unissued capital, whichever way. Called up capital is, when this IPO is done, so whatever capital is subscribed, so that is called from the investor, and especially the institutional investors are given an option of paying that capital in tranches or in in the form of EMI sort of thing. So they can pay that payment in three parts. So that is how this called up capital is. If they're calling the first part, so that will be called called up capital. And if it is paid, then that would be called the paid up capital. If it is not paid, that will fall under the unpaid capital. So that is how these terms are there, as in authorized share capital, unissued capital, issued, subscribe, unsubscribe, called up capital, paid up capital, unpaid up capital. All these terms are there. Right, so we should be clear with this concept of authorized share capital. Everyone should be clear. I hope it is clear. Any doubt, do let me know. We can further talk about it. Okay, then we will be doing the IPO. I'll not be. This is the same examples which is given there, and these one on the back of the same thing. So if you're clear with this thing, as in this thing, then you're clear with these examples also, I'm sure. But still, if you're not, I guess while we have this class, you also access your the same PPT on your phone and all, so that in case you want to have question around those things which you can probably see at your end along with this PPT, which you can surely see while I'm sharing my screen. You can also have the same PPT open on your phone or laptop, whichever device you're using. So if you have question around something else, you can probably also ask those questions apart from what I'm telling you. Okay, so let's take a break now because it's already 2:05 now. So let us take a break for 25 minutes and we'll start at 2:30. Okay.
Okay, sir.
Okay. All right. So everyone there, right? Okay. So we talked about preference share and authorized share capital as far as equity chapter is concerned, right? So now quickly on the IPO thing. So IPO is also one thing uh, which is quite often asked question in the interviews. Okay, so that we can quickly do. 1 second. Okay, before we jump to IPO, probably we can also look at this particular slide. Various way of raising capital. So public rights and private placement. So public company can raise first is IPO. That is when a company is not unlisted, when is not listed. So that means it is private only when the IPO is being carried out. I hope I'm audible.
Yes, sir.
Yes, sir.
Yes, sir.
Okay. Okay, fine. So these are the ways of raising capital. So when company is unlisted, so that is when company can do IPO and do a fresh issue and raise money. Right? Offer for sale is when private player who are having a private equity in an unlisted company, when they go and sell a stake in the company in the form of offer for sale. So that is called offer for sale. That can also happen in public company also. Some stakeholder already having some stake in the company and they want to offer that for some other players to buy it. So that is called offer for sale. So that public company can also do further public offering of our loan public offer. The once a company is listed, then company can again do a public offering. So that is called further public offering. And when company is doing it the first time, so that is termed as initial public offering. A rights issue is meant for the existing shareholder only. When you are the existing shareholder company, so company can offer more shares at a discounted price and raise capital from the existing shareholders rather than reaching out to the new shareholders and finding more shareholder for the company. They can just reach out to the existing shareholder company and offer the new shares at a discounted price, and that too with some ratio. So it can be 2 is to 1 is to 1 is to 5, 2 is to 10, right? Or the ratio will be determined by the company itself. So company will decide the ratio, and basis that ratio, that shares, more shares can be offered to the shareholders of the existing company. So that kind of issue or raising capital is called rights issue.
The
Okay.
difference between unlisted company and listed company.
Okay, so difference between listed and unlisted company is like when company is like you can have a private company with a private people like my family member invested in the company, right? So that's a private company, and I'm running that company for few years, and now I recognize I need more money to expand this company in other cities, or maybe to build a new plant. I need more funds, right? So that is uh, one kind of a thought process with the with the owner of the company have got. Now they can do as in all this stuff on their own, wherein they reach out to the investor, private investors, and say that you can get more money and expand and do other the other things which you have got for the company. So if the expansion is the vision, or making another plant is the vision, right? So all those things can be done by having those invest in the company. But another way is you can also go to public for raising capital. So when the private company goes to public for raising capital in the form of initial public offering, right? So that point in time, a company would be unlisted company. So it would be listed only after this initial public offering is done, and then that company would be listed on exchange like NSE, BSE, and trading of those securities, those shares which were issued in the initial in the initial form from this initial public offering in the primary market, those shares can be further traded in the secondary market. So that is called your, that is the unlisted company going listed. And unlisted is something which is not there on exchange. So if the company is not there on exchange, so that would be called an unlisted company only. Right? Clear?
IPO only offered by public companies.
IPO is, yeah, IPO can be only for public company. You can say the initial public offering will be for no, this initially would be for the unlisted, as in your company would be the private company only, as an unlisted company, you can say, Kanika. So once this initial public offering is done, so that is when the company is going to become public, you can say. That is when the company is going to be listed on the exchange, right? So initially it would be unlisted company only. But once this whole process of IPO is carried out, so we'll be discussing IPO, how it is done in the subsequent slide here only, in equity chapter only. So once the process is done, then the company will become a listed company. So before that, it would be called a unlisted company only. So you can say in a sense, it IPO is for the unlisted company. You can say that way.
Okay.
Okay. And further public offering is for the listed company. So once the company is listed, that company can further raise money from public, and that would be in the form of further public offering. So that is for the listed company, that is not for the unlisted company. Okay. Rights issue, I have as discussed, it is for the existing shareholder, it is not for the new shareholder. So company can raise more capital from the existing shareholders only, and they can offer them more share in a certain ratio, basis the number of shares they are already holding. They can offer more shares on a certain ratio, maybe just giving an example, 1:5. So if every investor has got 5 shares in the company, they would be getting one more share in the form of rights issue. And it would be on a discounted rate. So when I say discounted, that means the market rate is 1000, so they would be getting it for 950, as an example I'm saying. The company will decide what would be the discounted rate, but it would be less than the market rate. So and that way company is able to as in reduce the cost which is involved in raising money. So if company goes through this further public offering route to raise money, so this requires a lot of and to avoid that route, which is more complex compared to your rights issue, because here the company just needs to reach out to the existing shareholder for raising capital. So that is another way of raising capital. The private placement is called taking a stake in the company. So that is another way of raising money. So private placement for unlisted company is possible, private placement for listed company is also possible, right? So so in unlisted company, any private player wants to take position, they can buy that position uh, by reaching out to the owner of the company or the directors of the company. So they can sell the stake to the private player, and that way they can own a part of the company, or the share of the company can be owned by those private players. And when a listed company is there, they can offer that private placement in the form of preferential shares. They can also do a qualified institutional placement, wherein mutual fund, pension fund, they can also invest and take a uh, part of the share of the company can be owned by these players also. Fine. So that is about raising. Okay, let's come to
So,
the. Yeah, go ahead, Isna.
so can you please tell us about bonus shares? Because I was watching the PPTs on the LMS, and it was saying that the bonus shares do not impact the total market capitalization. So if the number of shares increase, ideally because one person gets more shares than they had, how does the market capitalization remain the same?
Yes. Yeah, right. So bonus share is as in this is given by from your when the company offers shares to the company, as in to the investors, right? So it is kind of a you can say a dividend, bonus dividend, which is going in the form of stock rather than paying the cash dividend. So company can also go for the stock dividend. So that is one, and it can be a bonus in a sense, in on top of the profit they also want to give additional so when you talk about market capitalization, right? So market cap as such, it is not going to increase. There is a reason behind it. So it is a technical reason, and it is not something which is, it is not going to impact in the long term. It is not going to impact in the short term, I would say, because in a very same proportion when the bonus share is issued, right? So market cap is reduced, so the price of the share will also reduce. Just if you remember, there is a company called Ircon. It's a recent one I'm talking. It's a recent where they have done this. No, no, not Ircon. There was another company. So when they would be offering that extra shares to the shareholder, so the market would take it into consideration, and accordingly the share price would be adjusted in the market. So that means the price of the share will come down with the same ratio. But again, this is not something which will be for the long period of time, because the number of share issued are more in the market. So the price movement in the market would be then decided by the market factor, as in the supply and demand only. So when the price will move, so market value of those share will increase definitely. But
The supply has increased, so the price would fall.
yes, that way you can say. But this is the temporary phenomena I'm saying. It is not going to be a long-term phenomena when this process is being carried out,
The
when the
capital
bonus is
gain.
being done. That is, yeah. So that is when the impact would not be there. Yes, the price will accordingly adjust to the number of shares raised, and it will equate to that market cap which it was earlier. But later on, maybe after a day or two or a week, right? So market phenomena, it is depending on the supply and demand only. So that way the price will change, and it will be different than what it was when it was done. So since the day of process, it will be same, but after the process is carried out, next day it will be different.
Got
But
it.
sir, if a
Yeah.
company is going to issue a bonus
Yeah.
share, then the demand of that particular company is
Yeah.
going to be increased. And if the demand is increased, then the price is not going to be fall down.
I
So
think bonus shares is only given to a few people who are already holding the shares, not to everybody.
yeah, yeah, but
Yes,
it is
bonus
given
is
in the ratio.
meant for.
So
Yeah.
yeah,
Yeah, go ahead.
it
Go
is
ahead.
given in the
Go
form of
ahead.
ratio that everyone having such shares. That suppose everyone having 100 shares. So the holder which is having the shareholder which is having 100 shares get a one share as bonus. So
Mm,
if as an investor I know that, then I am ready to buy more shares of that particular company. So the
mm,
demand of that particular share is
mm.
going to be increased. So if the demand is going to be increased
Right.
in the market, then how the value of the particular share is fall down?
Okay. Okay. So Akash, very good point. So I'll just to tell you. So you are right. The value of the share will rise, but it will rise only up till the record date. So I'm not sure. Like I do not want to confuse everyone, because we have not done this as in the corporate action. We have not done it. But still, just to give you a flavor, because Sana and you have asked this question. So before the record date, this price will rise, because in the hope of
Yes,
getting those bonus share, it will continue rising. And the bonus will take place when the record date will come. Before the
record date.
record date, there is no bonus. So on the record date,
Yes,
this will adjust, and this will come to the market value only. So that is when it will adjust. However, up till the record date, as in when the record date has not come, till that time your bonus, because the bonus is already coming on the share, and therefore the price of the share will move up and up and up till that time. But when the bonus date comes, as in the record date come, rather not record date, I would say it is called X dividend date. That is 2 days before the record date. So there is a one date that is called X dividend date. I do not want to go into nitty-gritty of that, but that is when actually the price will be adjusted, and there would not be much impact to the market cap. So I'll probably explain it again when we do the corporation, because then you would be able to relate it what we actually talk about. Fine. Okay, so let us move on to IPO. Give me a second. So let us come directly to this slide. Okay, it's this one. So qualification of listing of IPO. Did I share that PPT with you where the eligibility and all was mentioned? Because I do not want to share this one. I do not want to talk about the one which is listed there. You can just go with those one, because those were the recent one which I shared with you. So then appointment of IPO participant, registration of document, determination of the price of the issue, allocation of shares. So these are the process, you can say, the 5 process which involved in the IPO. So let's start with the first one. So that means before a company go for an IPO, they need to first figure this thing out, why they're going for an IPO. So the objective is raising capital, and what they're going to do with that money is something company should be very clear with. And if company is clear, then only they can go with the rest of the process. So rest of the process is they're going to talk to the investment manager. No, they're going to talk to the investment bank, who is going to act as an underwriter for a company to raise the IPO or to carry out the IPO, you can say. So investment bank like Goldman Sachs, Barclays, HSBC, Citi, they are all the big investment bank, right? So they can act as merchant, they can act as underwriter for the company to carry out the IPO process, right? They play the role of lead manager or the underwriter or the advisor to the issue, right? So they are the one who would be doing this process for the corporate, and they would be accordingly roping in more player to to make it a success, to make the IPO as a success. So they would be roping in more player in this entire process. So that is called syndicate member. Syndicate member are the ones who help advertise or facilitate the whole IPO in the market, or they kind of extend it to the general people, so that people can develop interest towards the IPO and they can participate in the interest. So that's the role of the syndicate member, like ICC Security, Kotak Securities, right? So they also sort of play a role in the IPO with the help of the lead manager. Lead manager are the one who are the underwriter for the whole IPO. So as you can say, it can be international bank, it can also be the local Indian bank also for the IPO company. So they carry out the IPO, and the syndicate member help in advertising or reaching or help in reaching this IPO to the other participants, or the general people,
Who all
right? So
are
that is
local underwriter for IPO process in India?
in India. It is the ICC Security, Kotak Security. They also play the role of underwriters. So they are the main investment bank, you can say, right? They're into security business. ICC Security, Kotak Securities, all these banks, big banks in India, the private banks. So they also have their investment bank arms. So investment bank arms play the role of underwriters for Indian market. But it is not only they can play the role of lead manager or the underwriter. Even local company can also hire international bank like Goldman and Morgan or Barclays. They can also play the underwriter role. So both way it is possible in India for Indian companies. Okay, so what they do, drives in roadshow conducted by the issuing company. Roadshow are considered to be one of the biggest way to increase the subscription. Roadshow means roadshow does not mean going directly on the roads and carrying out the rally and all. It is not that way. It is more about uh, as in advertising about the IPO. So it can be the online advertising. It can be with the help of the syndicate members. So the branches have got the advertisement, right? And whenever the customers or when the customers to the bank go to the bank, they can see the advertisement, they can inquire about the IPO and all. Then and at the same time, the bank officials can also pitch in about the uh, about the open IPO, so that their customers can buy to those IPOs. right? So that is how this roadshow is carried out. It is not necessarily going to the roads and then doing the IPO. Okay, so what is the role of registrar? So this is one second. There is one more. Okay. So before covering this, probably I'll like to spend some time here because that will give you a better view about how the IPO is actually done. So drafting and designing of offer document, prospectus, statutory advertisement, and memorandum containing salient feature of the prospectus. So this is done by the IPO manager or the lead manager, or you can say the underwriter. So they prepare a draft. Draft will have all the information as in what money company wants to raise, and the financial statement and the financial valuation of the company, everything would be mentioned there. So this document would be presented to SEBI in the form of red herring prospectus, that is called RHP, and SEBI needs to approve it. SEBI can suggest some changes in RHP, and or it can directly go and approve it. So once it is approved, then the company does the further process wherein they decide about the price and all. So how the price of the IPO is decided, it is decided with the help of a process called book building process. Book building, if you have heard about this term, you must have heard earlier. So book building is the process wherein the underwriter reaches out to the various institutional investors like mutual fund and pension fund and various uh, other investors, and they give their quote in terms of the quantity they're ready to buy, and the price at which they are comfortable buying the share of the company, share of the company which is going for IPO. So that process is called book building process. So they're reaching out to various stakeholders in the market, various mutual fund, various institutional investors, right? So every investor would be giving their quote and their quantity, what they're going to, what they're comfortable buying. So basis that process, the this price would be averaged out, right? Price would be averaged out, and the final price would be determined by the underwriter, as in they will look at what is the high, as in the high end price. So maybe there are investors who are ready to buy a security. Suppose there is a security ABC at 500 rupees, and there are investors who are ready to buy the same security at 45 for 450 rupees, right? So now the underwriter needs to do an average out of this price difference, and come out to the price of the security, as in to come with the real price or the ideal price of the securities, which would be comfortable for most of the investors. So they should not be going for a price which is just a uh, upper upper band price, or neither they should go for the lower band price. So the underwriter accordingly decide which would be the better price after reaching out to the various stakeholder who are ready to take a position in the company. So that is how they're going to determine the price, and this process of determining the price is called book building. So where various investors would be giving the quantity and the price of those security which they're ready to buy, and then the underwriter would be kind of averaging out and finding what would be the best price to offer to investors. So that price has got floor and cap. Floor is called the lower band price, and cap is called the upper price. So retail investor can choose floor to upper price, any of the price they can choose in between. So the range would be given there, and the retail investor can even choose the price which is offered in that range, right? And the institutional investor has already opted for the price. So basis that range, this particular price is offered to the retail investor. This price which is calculated post this book building process, this is meant for the retail investors only. So okay, so when this is offered to the investor, then what happens? The post issue activity, including management of escrow account, coordinate non-institutional allocation, intimation of the allocation, and dispatch of fund to the bidder. So this activity This particular activity is done by registrar. So what a registrar does, as we discussed in the earlier presentation also, registrars are involved in carrying out the admin work for the IPO process. So they are uh, going to mm, going to offer the as in the shares later on, but before that they are going to have the application of all the investors who are willing to put their money. Accordingly, escrow account would be made where all the money would be deposited for those investors who are putting their money. So that money will be held in escrow account, and then all those bids which have come would be collated, and then the draw will happen, or you can say the after that draw. So the lucky investors been who have been offered those securities would be given the respective shares, and they would be transferred in the demat account. And the rest of the investors who are not eligible, or who did not uh, got their name in draw, they would be getting their money refunded, right? And then this registrar is going to do the reconciliation of the demat allocation and the the fund reconciliation. The fund would be reconciled with the demat allocation, so that it is determined the share have been handed is handed over to the right customer. And once this process is over, which is carried out by the registrar along with the underwriter, right? So then the funds which are there in the escrow account, those funds would be then sent to the issuer of the company who is issuing this, who's doing this IPO. Then after this whole process is carried out, the then your shares would be listed on the exchange, and from there on the trading on those shares can be done. So this is your whole IPO process, right? Anything not clear or maybe confusing, because you have already done this earlier also, so that's the reason I've done it very quickly. Book runner, underwriter, merchant bank, investment bank, these are few names which are given to the underwriter only. Book runner because they are going to run the book of the company, so that's the reason the book runner is also the name given to the underwriter. Underwriter, merchant bank, investment bank are the names which are interchangeably used for the underwriter only. Okay. Anything which you are not clear with?
Just one clarification. IPO is meant for only primary market and FPO is meant for secondary market. Is it correct?
Yeah, you can say that way. IPO is meant for primary market, and FPO is meant for the company which are listed. But it will happen in the primary market only. It is not going to take place in secondary market. The process of issuing or raising capital always takes place in your primary market, you can say.
And sir, what kind of securities are raised in IPO? I mean, is it the money market or the long-term securities are issued in IPO?
Yeah, it is the long term, you would say. The IPO has got the long term security, because equity and the debt which is offered in the primary market, this is for your long term only. So that is your long term, you would say. The primary market, which is part of the capital market, has got long term securities. Okay. Fixed price and the book building that we have done. Book building price is carried out to discover the price of these securities, to find the right price of security, which is why the book building process is done by the underwriter on behalf of the company. So other than book building, there is another process that is called fixed price IPO, but this generally is not that relevant in the current circumstances. It was one of the methods, and is one of the methods, I would say, which can be followed by company, wherein the price is decided with the underwriter, in consultation with the company, and that is fixed. So there is no such advice or reaching out to the institution happen in case of fixed price IPO. So it is just directly the company decide which price they want to go with. So that is called a fixed price IPO. However, in case of book building process, it is very organized way of deciding price, wherein you reach out to the investors who are ready to put their money, especially the institutional buyers, and they decide what quantity and the price they are willing to buy for that company, and on basis that estimate, the company does an average of those price, and accordingly they come up with the lower band and the upper band of the security, and then they offer it in that price range to the retail investors. Okay, any confusion?
Sir, can you explain it again?
This book building, right?
Yes, sir.
Yeah, so the book building process is the process to determine the price of security. So the IPO, as you know, is done by the underwriter. As an underwriter is the one who is facilitating the whole process, right, on behalf of the company. So they first file the red herring prospectus, which has got the information of the company, the financial of the company, valuation of the company, and the vision of the company, why the company needs money, company what company has got to do with that money in future. So all those details would be mentioned in the prospectus, and it is given to the SEBI. And SEBI then looks at the prospectus, and if they find it's all good, they're uh, going to going to give a go ahead to the company, right? And then the underwriter is going to do the book building process to find the right price of the security. So to do this, what they do, they reach out to the institutional investor, and they ask them what quantity they are okay to buy and what price they want to buy them. Right. So this basically, and the institutional investor always decide the price basis the valuation of the company. So they look at the book value of the company, and they see what is the real value of the company, asset minus liability and all that, right? That the book value. So the looking at the book value, and then what is the acceptability of that particular share in the market, and how the company is going to do in the long term. All these factors are taken into consideration when the institutional investors give their price quantity to the underwriter. So they offer, this is the quantity they are comfortable buying. This is the price they are ready to buy the share at. All this detail is given, and then this is put in order. You can say highest to lowest order. And so what a company does, company can average out them and accordingly decide the price which would be the best price for the security, and they can also go with within a highest to lowest order, as in that is the underwriter of the company prerogative, which way they want to come up with the price. But generally the price is calculated with the average only. They look at the highest bidder and the lowest bidder, right? And they do the average of those prices, and then they come up with the price of band, as in the lower and the upper price band. That price band is offered to the shareholders, as in the retail shareholders are can bid anywhere in that lower to upper band. So as a lower to upper band, you can say, so once this book building process is done, right? So it can be like 145 to 50 as a price band which they come up with after the book building process. So the retail investor can go with the 145 also, the lower price, which is called floor price, and they can also go for the 150 as the upper price. Most of the time I've seen whenever the IPO is bought, that is bought on the upper price only, but you can choose the price which is given in this range. That is up to the investors only. So if the IPO is undersubscribed, then you can probably be able to avail it. However, if the IPO is oversubscribed, then there are chances if you have taken the lower price band, so you are not getting an option. Even you are screened out in the beginning itself, because your price is not the highest price. So that is how this IPO process is done. Okay. Any confusion? Okay, so this I'm not going to discuss. This is unsuccessful bid, successful bid, undersubscribe, oversubscribe. These are the things which are when the subscription when the
Sir, I do have a question related to the price of the shares. So,
yeah
as you said, there will be a price range, the upper price and the lower price bid, the range. Can't the investor get the fixed price that you have to buy at this price or the quoted price of the
yes
shares?
as an
Can't they get that?
you know so when you saying when it is offered to the investor, right?
Mm,
As in,
yes, maybe it's all about the price, right? So either it's to the investors or the retail investors or something.
it can be done. It is not. It can't be done. The process because it all depends on the underwriters only, right? So they can go with one price as in the fixed price also, and there is a process of fixed price IPO also. That is when it is the fixed only, wherein the one price is quoted, and basis that price, all the investors are going to buy those securities. And same can be in case of book building process also, but the general trend is where they go with the range, as in the lower band and the upper band. So that is how they want to cater to the large investor. They do not want to leave any opportunity for themselves. Maybe the it is undersubscribed, so maybe there are few investors who are interested to buy the IPO at the lower band. They're comfortable buying at the lower band, but they're not comfortable buying at the higher band. So that's the idea behind having the this band range, and it is in that perspective this range is given so that all the investors who are comfortable with the lower band, they can also go with that one, and the higher price, if the investors are comfortable, they can go with the higher one also. So
So
that
who
is
will go with the higher price then? अगर उनको एक price range मिल रहा है where they can buy the share, buy any kind of share in 200, or why would they pay 300 or 400 for that,
okay.
for the
Yeah.
same one?
Right, good point. So I'll tell you how that would be that way. So let's look at a company like IRCTC, right? There is a company, and if it goes for an IPO, everyone would be very keen to buy this IPO because they see a very potential of this company growing in future, and as in the huge potential of this company growing in future, right? And therefore, give though the company has given you the price band of example, we took the same one 145 to 150. 145 is the lower and 150 is the higher. So you as an investor is allowed to either buy at 145 or 150, whichever band, right? So now, given this choice is there, so you might have opted for 145, right? So 145, and there are investors who have gone for the higher band. Many investors who have gone for the higher band. So the first priority would always be given to those one who have opted for the higher price rate, and then I would be coming down to the lower band, as in the lower price. So if I find enough investors, as an enough investor who can complete my requirement of the capital raising which I'm doing with the help of this IPO, which are already available in the higher band, why would I go to the lower band? So if it all if the investors are very keen and they have a very high hopes with the company growing in future, so they all would be opting for the higher band because they don't want to lose out the opportunity of not getting the IPO. That is the reason they're opting for the higher band. However, the company is not as in the investors are not comfortable. They don't think there is any potential in the company growing in future, though the company has come up with this IPO, and they are not comfortable, so they might be going for the lower band. But given they have opted for the IPO, and the IPO itself is undersubscribed, therefore they will also be eligible for the IPO, and they will receive the share of the company. So that is how it is. It can happen, Shivani,
Okay, sir.
right? So that is
That option, is the price fixed or is the price variable?
as in case of book building.
No, sir, Dutch auction, specifically Dutch auction.
No, it is not fixed. It is a choice given to the investor, so they need to give one
Sir,
this
it is
Dutch.
a choice, but after the bids are received, isn't it fixed at the lowest bid?
No, 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 no. It's not the lowest bid. So lowest bid is So okay, you're saying the lowest bid is for the institutional investor. That is for institutional investor. You see.
So, I mean, what I read was that in a Dutch auction, all the bids are received and then they are arranged from like an increasing, like the highest to the lowest bid, like in a decreasing order. And when the number of shares which are supposed to be listed gets over, then the number of lowest bid which was, so say somebody bid 100 and the others bid 80, and there was a range between the same. So finally the price is closed at 80, and those who were expecting to pay 100 also have to pay 80.
Yeah, that's true. But that is only for your institutional investor. You true, right? In Dutch auction process is carried out for as in finding the price where the price is lying. So here this
That's called
price
price discovery.
this price is for your institutional investors.
Got it.
So all the institutional investors, whether they have bought it at 100 rupees or at 80 rupees, if the 80 is the lowest price where you buy, where you are finalizing the price for the security, so 80 would be applicable for all the institutional investors when the price is uniform. Remember, Sana, there are two things. Even in Dutch auction process, there are two clauses applicable. One is called uniform price, another is called non-uniform price. So non-uniform can be wherein all other, as in the investor, whatever they've opted, they will go for that price only. So, but if it largely Dutch auction process has got this tendency of following the uniform price where every investor is given the one price only. So applicable for institutional, as I said, it is not meant for the retail investors, first of all. So one, let's suppose 80 is the lowest price, lowest bid, which is coming with the Dutch auction price method. So that would be given to all your institutional investors. So now the retail investors would can be have the same one price, but most, if you look at the trend uh, in case of IPO, you would have seen this lower band and upper band. Mostly all the IPOs which you would have seen, they don't have one price for retail investor. They always have a range. This range is not quite big. It is just a 5-10 points range. It's not a big range. It's not a huge variation there. But there is always a range that is called lower band price, or the floor price, the cap price would be given to the retail investor also. So that is how it is there. In Dutch auction process, you can say for institutional investor, it is going to be uniformly priced if it is uniformly mentioned under the Dutch auction. If it is not uniformly, so then it may also be possible wherein in the institutional investor is also buying a different price. So one is buying at 100, another lowest participant who's falling under that category, as in what number of share I can offer to the institutional investor is a limited. It's limited. So if that is fulfilled within that range, right? So maybe the lowest is getting the 80, the highest is getting 100. So that is also possible if it is non-uniformly priced. If it is uniformly priced, then it is this lowest price would be offered to all the institutional investors. Okay, Sana?
Got it, sir.
Okay. Any other question, guys, before we move on? So IPO is always important. So keep it in your make it a point. You always cover it. So these are few examples given to Alibaba. See, the deal size was $21.76 billion dollar. And so these are the few big names given there, just for your understanding. Secondary market, you know what secondary market. I'm not going to spend time here. I'm just going to move now coming to your ADR and GDR. Anyone not clear with ADR, GDR? What are depository receipt? Anyone want to explain?
So the depository receipt is one which is used to raise the fund from the used to issue security and raise the fund from the foreign market. So it is of basically three types: ADR, GDR, and IDR. So basically, ADR stands for American Depository Receipt. If someone wants to raise the funds from America, then they have to issue ADR. And if any other country want to raise funds from India, then it has to issue IDR. And if other than if I want to raise funds other than America globally, then they have to raise through GDR.
Right. Clear. So anyone want to explain the process also? He has explained what these receipts are meant for? Apart from Akash, anyone else want to explain?
So let's say one company, HDFC Bank, want to issue share, want to issue share in America. So let's say HDFC Bank go to one local depository with his share like 10,000 share, he gone to local depository. Then local depository will go to global depository. There he will convert his 10,000 share into some portion of ADR. Let's say for every 10 share, there will be 3 ADR will be given. So likewise that 10,000 share will be converted into ADR, and that ADR will be traded in US stock market.
Okay.
So that's how can HDFC can be traded in US.
Okay, fine. So I hope everyone is clear, like how this is the process is done. So ADS is meant for the for America. If a company wants to raise money from America, so they would be carrying out ADR. And if a company wants to raise money from other market, as in other global market, so then that would be called GDR. And so that is how these two receipts are different. So this process is such wherein the entity who wants to raise this money, so this entity will reach out to the global depository bank, which is based out of your respective regions. Like let's take an example of India. So the entity will reach out to global depository, which is based out of America, and they will agree with the process and everything, right? And then they will decide the ratio in which the ADR is done. So general trend is wherein the ADR is usually one DR consists of 10 shares, right? This is the usual ratio, but it can be customized. It is not something which is fixed, it can't be changed. So this arrangement is agreed, and once this is done, so the company is going to hand over the share of its company to the local custodian of the global depository, which is based out of India, right? So then once this process handing over of the share is done, so then the global depository is going to issue the shares to the US investors, and those it is going to be issued in the form of receipt only, depository receipt, right? And then these receipts are also tradable. So these are listed on exchange, and these can be tradable, and then they will be driving its value from the normal trading happening on the exchange. And the final, as in the, you can, the underlying value will be coming from the share of the Indian company only, but it will have its own liquidity in on the exchange basis the supply and demand there, and it can be traded on the exchange of America in case of ADR receipts, right? So that is how it is. Any questions? Anyone?
I just want to confirm one thing,
Yeah.
that when the company declare the dividend over these shares, then the dividend is going to the local custodian.
Okay, very good question asked. Very nice. So there are two kind of ADRs or GDRs can be. So one is your sponsored ADR, right? You know, which is the one that we have discussed right now. So this is called as where the company itself is going and raising money from overseas, from America, as an example that we discussed. So in this case, the dividend will be going to the actual owner of the receipt. So dividend will be going to the investors only. If it is the sponsored ADR. Sponsored ADR is when the company itself is going and raising money in the form of ADR. However, there is a possibility the ADR can also be raised in non-sponsored form, no, unsponsored, I would say. So unsponsored is when the share of that company is held by some other company, right? And so that company can also carry out this ADR process. They can also reach out to the global depository bank in America and propose the same arrangement. The process will remain as it is. So here, this dividend and the voting rights, because every share has this option of dividend and voting right. So this will remain with the global depository bank. It will not be extended to the investor because it's an unsponsored ADR. So in case of unsponsored ADR, the Global Depository Bank holds this right of voting also, and also the dividend. So this is not going to be passed on to the investor. In case of sponsored ADR, the voting right will be passed on. Similarly, dividend will also be passed on to the investor. So that is how this process will happen. Unsponsored ADR before, as in maybe if you have confusion, unsponsored ADR clear? Everyone? Any confusion with unsponsored ADR? So process will remain same. It is just the this handing of the share will be done by not the company, as in if the company is Wipro is doing the ADR. So in this case, Wipro is not the company. So maybe you say there is one institutional player that wants to do the ADR of those shares, Wipro shares. So that is called your unsponsored year. So that in that case, the voting rights and the dividend payment will remain with Global Depository Bank. Clear? Let's move on. So if you're clear with ADR, then you are also clear with GDR. GDR is only when your receipt is listed on other international markets other than America. So like Luxembourg and UK and all other markets, if the share of the company or the receipt is listed on those exchanges, then that kind of receipt is called GDR, right? This example we have done, so I'm not going to talk about these then now. ITC has a GDR, right? ITC has got its GDR, which is listed on Luxembourg and Singapore Exchange and London Stock Exchange. These are not Indian company. ITC is an Indian company. So this is listed on Luxembourg Stock Exchange. It is also listed on Singapore Exchange and also on London Stock Exchange. So this is one GDR that is there. IDR, I am sure you clear with IDR also.
Hello.
IDR, yeah, go ahead.
Sorry, sir. Actually, I got disconnected with the class.
Oh.
So I just asked my question that what about the dividend that who got the dividend in case?
Okay.
Can you repeat it again once?
Yeah, I'll do that. So in case of ADR, GDR, so there can be two kind of ADR and GDR. One is your sponsored ADR, and there can be unsponsored ADR also, right? So in case of sponsored ADR, then the dividend and the voting rights will be with the investors only. So once the Global Depository Bank issue those ADR to the investors in America, right? So American investors would be holding the voting right, as well as the dividend. So they're going to receive the dividend payment. However, if it is the unsponsored ADR, so unsponsored ADRs are the one which are not issued by the company itself, rather some other player who is owning the shares of the company, so they can also do the ADR process, and that kind of an ADR process is called unsponsored ADR. So wherein, let's suppose there is one institutional player who's got lot of shares of one particular company, and they want to raise money on the back of those shares which they are holding from that company. So they can also reach out to the Global Depository Bank and ask to do the ADR, provided the liquidity and everything is there in the overseas country. So once this process is agreed, so given this process, the unsponsored ADR is done without the consent of the company, right? So this right of voting right and dividend payment would be with the Global Depository Bank only. It will not be extended to the investor, right? So that is how it is going to be.
Okay, sir. Thank you.
Yeah. So IDR, I'm sure you clear with IDR also now, because process as it is, process is not different. Process is same, but it is just going to be that way, as an you know the US entity doing this IDR process will be reaching out to Indian Depository Bank, who is carrying out this IDR process in India. And then once they have agreed for the process and everything, then those shares of the local company, of American company, will be handed over to the local custodian there in America, which is a local custodian for the Indian Depository Bank. And once it is done, then this idea can be raised. So as of now, there is only one idea in India, that is your Standard Chartered Bank. It was uh, it was issued on 25th May 2010. Right, clear everyone? So that's it in case of your equity. So in short, uh, preferred shares, authorized share capital, IPO process, right? And then your ADR, GDR, all these things are important as far as your equity chapter is concerned. Let's move on to money market then quickly. So money market, various kind of different money market instruments one should be very clear with, like T-bill, commercial bill. This all you know. I'm not going to talk about this now, because I'm sure you know this. I'll come directly on this slide, wherein we're talking about these different kind of instruments. One is your bill market, commercial bill, treasury bill, CDs, CPs, right? So all these instruments which are there, you should be very clear with what is T-bill, what is interbank lending, what is commercial paper, what is repurchase agreement, what is, right, your CDs and all. So this is something which you need to be clear with. Call money, notice money, weekend money, term money, intraday money, right? So these terms which are part of your interbank lending only. Okay, so that is what you should be knowing. And even not clear with this, why we are doing interbank lending, why interbank lending is necessary for bank. So there could be a question of that kind also. Why banks are doing interbank lending? Any uh, any reason that you can think of?
Yes, sir.
Yeah, go ahead.
The bank do the have to maintain the CRR.
Hmm.
So that's why they do this, because at a particular time the bank has to maintain some cash, and if they have a shortage of that cash,
Hmm.
it is for the shorter period of time basically.
Hmm.
So to complete the requirement of the cash, they have to advance from the bank for a shorter period of time. That is
Correct.
the reason why they are dealing with that.
Right. Absolutely. So yeah, rightly said. So bank need to comply with this requirement of CRR and SLR, right? CRR stands for cash reserve ratio. So every bank needs to meet this cash reserve ratio, which is set by RBI. So in order to fulfill this requirement, they need to go for interbank lending. So at times when they're falling short on their cash reserve, which is needed as per the RBI requirement, so they can go in the interbank lending market, which is part of your money market only. So they can accordingly avail money for a period they want to take it, and get their requirement met accordingly, right? So that is how this interbank lending is. Repurchase agreement. What is repurchase agreement? Any idea? Anyone understand what is repurchase agreement?
Sir, it is done for immediate cash requirement, like sell your security. You promise that you will sell your security at a later date. It is called.
Okay, right. Yes. So maybe you have seen this web series which is made on Harshad Mehta. I'm not sure how many of you have seen this web series was made recently, and you remember like how this guy Harshad Mehta was using the securities back then, which were which were rather he was not using security, but he was using this arrangement of cash, uh, which is on the back of security sale process, and he was able to use those. Though you were able to use the money for certain number of days. So that was possible back then. Nowadays money market is has not got brokers, but earlier the money market was also having brokers. So these kind of transactions like security selling and all used to take place with the help of brokers in the money market. But now there is no broker, it is all banks going directly there and carrying out this kind of a process. So that's a good thing. That's a change in the market structure or market, the way market operates, you can say. So repurchase agreement is like wherein you are selling a security the to the investor or to the entity with a promise to buy the same security at a later stage. And so when you're selling the security, what you would be getting, you would be getting money, right? So that money is the requirement for you. You need money for a short time, and on the back of the security you're getting that money. And once once this requirement is fulfilled, you would be buying your security back and returning the money along with the interest payment to the investor. So this is the repurchase agreement. So here it is. I think repurchase agreement is at the later. Okay, no worries. We'll look at it. Is a subsequent slide, not here. Okay, so trade economics in money market. So that is how the trade would look like. Trade date would be there, settlement date, price of the contract, notional amount, counterparty, trade direction, DCC, calculation of interest amount in deal, brokerage, settlement amount, standard settlement instructions. So all these are the trade economics. When I say trade economic means how trade economics means all the details of a trade, what all parameter attributes a trade has got, that is what is reflected with the help of trade economics. Fine. Just an example shown how deal is struck with with the player in the money market. So if there is a they agree for interest rate and all, what interest rate they're going to pay on the deal. So that is how this is. T-bill, anyone not clear with T-bill? Everyone clear, right? I'll just move on. So T-bill are issued at discount, right? And redeemed at par. So this concept I'm sure all is aware, right? Anyone not aware with this process of
So, sir, these are like discount bonds or zero
this?
coupon bonds.
Yeah, zero coupon bond. Yeah, you can say this is kind of T-bill is also kind of a zero coupon bond only, right? So T-bill are kind of zero coupon bond only, because zero coupon bond have got the same feature wherein they're issued at discount and then redeemed at par, right? So same is the case with the T-bill also. They are also issued at discount and redeemed at par. So you can say T-bill is also a kind of zero coupon bond.
There are T-bills issued by government.
Yes, T-bill are issued by governments only. So the T-bill US government issues. So T as a word is treasury word is used by the as in US government. Indian government use G for government, right? G securities is the word that is used by Indian governments. But T-bill is meant for those securities which are issued by the US government. But this is now used in the global market. So T-bill is very known word used by as in is studied with the with T-bill only. But when US as in the Indian government would be issuing, they would be mentioning G securities or G bills. You can say that is how they're going to issue them. But they are issued by the government only, right? So again, the
So,
Dutch auction presses. Yeah, go ahead, Amit.
so these are used as risk-free rate in case of discounting.
Yes, yes.
T-bills.
Yeah, in case of discounting, the this as in the interest rate, you can say is always the prevailing interest rate basis. It would be higher than the prevailing interest rate for sure. Then only the investor would be happy to put their money into T-bills. So the prevailing interest rate is 6%. Just to take an example, so the T-bill should be having higher interest rate. Rather, not T-bill. T-bill, have got a discounting process, so it would be based on as in the calculation would be discounted, and but the interest rate would be more than the prevailing interest rate. But the discounting method would be used to come up with the discounted price of the T-bill.
So, sir, when we use the CAPM model, we have risk-free rate.
Hmm.
So, are T-bills used for that discount risk-free rate?
I'm not as in getting it fully. Maybe if you can just repeat the question.
So when we use the CAPM, we have the risk-free rate, right? Risk-free rate plus the market premium, we can say,
Yes.
and the returns above the risk-free rate.
Hmm.
So when we talk about the risk-free rate, are T-bills used for that rate, or we have different rate
Yes,
for
yes,
that?
yes. The TVL is taken for a risk-free rate, you can say, because the as in the country when you calculate the base level interest rate for any of the instrument, you can take it from the government schemes like PPF and all. So T-bills, the government securities are the benchmark for those risk-free rate.
Okay.
Yeah, benchmark is T-bills only, you can say. Okay, so again, Dutch auction process is also carried out for your bonds also. When the bonds are auctioned, so I guess there was some question. I guess it was from Nishant, right? So he was asking about how bonds can be traded, how bonds can be bought. So I was reading one, as I was watching some video. So there is one application, one app is nowadays available that is called Golden Pie, if you've heard. So Golden Pie app is now available, wherein even it is available for retail investor, because institutional buyers were able to do this buy and sell of these securities with the help of the brokers and all. So in the auction, in this primary market, that was not a big deal. Now even for the retail investors, so if you want to buy some bond, right? It can be bill, it can be your normal bond which has got a longer maturity. So debt instrument in short. So you can go to this particular application, Golden Pie, and there you can see different bonds, and you can probably buy them if you want to put your money, rather than going to the broker and all those things. So you can also avail this opportunity from this application directly. That's a good medium now available. So this is connecting to the OTC market only, but now the platform is
So
available.
even I checked.
Yeah, yeah, Nishan, go ahead.
So even I checked that.
Yeah, you did you also
I
check the
also got one more website. It's called Fixed Income. So
fixed
there
income?
also we can buy the.
Okay, okay, that's
Yeah,
great. That's great. So
yeah.
now
So from there
because
also we can buy the bonds.
okay, okay, that's great. So now even the bond availability is also as in because the financial market as such is evolving, and it is expanding. So people uh, are also getting this this option of reaching out to the various markets. So earlier it was more of equity only, but now the investors, even the retail investors, are encouraged to buy securities from debt market or from other equity markets. So this is good initiative, I would say, because that way investors have more options rather than having only the equity as an option, because debt option was earlier available only through mutual funds only. That was largely, or going through broker, which was more sort of a, brokers usually entertain larger institution buyer rather than a retail investor, because it is not that useful for the broker to entertain. There's some broker who entertain for this buy and sell of security, but now given this kind of platforms are available, so it is going to be good one. So your security will again be coming in a demat account only, this debt security. Okay, so coming to the Dutch auction process is largely the same, which is there in case of shares also. So that is called competitive bidding, and non-competitive bidding is meant for the retail investor. So once the price and everything is decided, so then non-competitive bidding is that price which is decided for the retail that price which is decided with the help of the competitive bidding. That price would be meant for non-competitive bidding, non-competitive investors. That is called retail investor, you can say. So that price would be non-competitive bidding price only. So let us assume, you can look at the example here to understand the bidding process. Let us assume the Federal Reserve wants to issue T-bills worth 4 million. Each bid is for minimum of one T-bill. Cap is 1 million, right? Cap means your upper price, and the floor is this. So that is uh, given there in the bidding process. Now all competitive tenders are ranked in order of bid yield. The lowest bid price is accepted first, and as a result the highest bid price is accepted until the issue is sold out fully, right? So this is same process that we have discussed in case of your book building also. This is also followed for debt debt process also. When debt is raised, when fund is raised on the back of debt securities, then also this process is followed in the market. Okay, so these points I'm not going to cover, because these are again, and this we have largely discussed. Uniform discriminatory, something this we also covered. Cap, floor, you already know. Then the final thing is commercial paper, I'm not going to cover it, but still if you want me to explain, I can do that, but I take it you already know about them, so that's the reason I'm not spending time here. Repurchase agreement we already covered. Haircut, what is haircut? I hope you know this. Anyone not clear with haircut as a term? That's it for in your. So you need to be clear with all different kind of instrument, like T-bill, repurchase agreement, your interbank lending, right, and commercial bills, um, all these Dutch auction process that we have discussed in the form of competitive bidding as a process. That is what you should be you should be aware. And what is CRR, SLR, all these terms which we have, one should be clear. So this is what would be there in money market largely, right? That is what would be there in money market in terms of your interviews and mock interviews and all. Okay, so that's it, the time we have got. So in this class, so rest of the items we would be covering once we are through with the derivative. Then we would be doing the rest of the revision. We will have one more revision class, that's it, before we do the mock level 1. Okay, so first we will be completing derivative, so that we are completing the entire syllabus or entire all the topics of level 1. and at the same time revision is also going on. It should not be left for the last moment only. We should be doing side by side. So that's the intent of this class. You all are comfortable what we have done. If something is not clear to you, probably you can come up with those questions in the beginning of the session, every session for that matter. We can take those questions then also. Okay, so before we discuss about because about your mock and all, as Sana said, any other question?
Yeah, sir, I have a question.
Yeah, go ahead.
Sir, in portfolio management, when we talk about diversification,
Hmm.
we usually add assets that are negatively correlated, right?
Yeah.
And we can also use derivatives for that. So which one is better, to go with assets or to go with derivative contracts? Or is it the
So
same thing?
okay, so this is Amit. You say when you say diversify, one is you want to mitigate as in the loss that you may incur on the portfolio. So
Yeah.
when you say negatively correlated, so basically you try to have your you have different assets which give return uh, in a different direction. When one market is going down, so maybe the other market is supporting or moving up. So that way it should be negatively correlated. But if you take a position in derivative, so you can mitigate your losses also. You can take a position wherein you can actually hedge your position. So derivative market is more meant for the hedging and all. The idea, the fundamental idea when it was more from the hedging point of view only. To as if you take a 50 position, so you can cover your position with the help of derivative. So that is how it was. But from the portfolio point of view, diversification is needed. Why? Because you right. So that is the main reason. So when you look at from the portfolio point of view, when you say the negatively correlated thing, so negatively correlated is needed. Why? Because if it is not negatively correlated, maybe let's suppose the equity market is really doing good and you put all your money in equity, and one fine day the COVID scenario happens and all of your money is wiped out. So that means 70% of money is gone. That means you left with 30% of your invested money. So that would be kind of a shock to you. So that is why the portfolio manager look for assets which have a negative correlation, or if not the entirely negative correlation, maybe some of the negative correlation, wherein and if one market is not doing good, the other market supports or maybe doing good, thereby your net value is not impacted much, rather you are always on the profit only. So that is how you can say the portfolio manager look for those
So,
opportunity
sir,
of. Yeah.
for this case, can he take gold or gold bees
Yes.
as an asset?
Yeah, absolutely.
Because
So
if even if the market will go down, the gold will go up now.
yes, yes, I agree. So that's the reason. Even if you see a fund manager and all, they also suggest to put some of your exposure towards gold if you're building a portfolio. Right? So they also give this advice to put some part of your money in gold, and that is primarily to hedge your exposure. Because if you have entire exposure towards equity, and no one knows what is going to happen in equity. Let's suppose tomorrow there is a war with China, right? So for sure the equity market will go down and no FI investment will come until this war is settled, right? And therefore you are going to lose your money. As in I'm not saying lose your money, but if your value is reduced, it is kind of a you lost your money, right? So maybe it is recovered in some months or some years, but still for that period when you need money, if that money is not available for you, it is a loss, right?
Sir, when we draw the efficient frontier line portfolio,
Hmm. Which
we have
one?
minimum efficient frontier line in portfolio
Yeah,
management.
yeah.
So we have the minimum variance portfolio, and below that we have dominated assets. So why are they called dominated assets?
Dominated asset.
Yeah, this portfolio lie below the minimum variance portfolio on the efficient
I'm
frontier
not
line.
very. Okay, I'm not very sure to be honest. Maybe we can take a look at this. I can try to check this. Maybe you can just WhatsApp me this
Okay.
particular statement. I can try to look at my level to understand this thing. So you have my number, right?
No, I don't have, sir.
You don't have, no worries. So I'll share my number. Give me a second. Mm, we can check this. No worries. Got it?
Let- Yeah.
Okay, fine. So, okay, any other question before we? Uh, okay, Sana. So you were having as in any specific thing that you want to know, or just a normal way, like how this will be done and all that, or any
Something
specific question
specific
that
with
you
the
have?
pattern so that we can prepare accordingly. Like, is it going to be questions asked or like
Okay,
how
got
is
it.
the pattern of the interview? Like,
Okay. So it is going to be as in for 20 minutes each for every one of you. And the pattern would be, you can take it that way, like every chapter that we have done, there would be a question from every chapter. So, and it is not going to be written, it is just going to be mock only. So, written there would be, but that would be at the end of the certification that will have your 100 questions. That would be the final written paper. Other than that, the assessment that you have, the quiz and assessment, that is the only written that we have.
this is like
And this is your, yeah, viva, this is your viva, so wherein mock interview would be conducted for all of you, right? And that will be for 15 to 20 minutes each person. And you would be assessed out of 30, right? 30 would be the as in the total marks. Out of 30 you would be given uh, your marks. So that is how this is going to.
There will be only objective questions that are going to be asked.
No. In your mock,
Yes, sir.
no,
In our
no,
mock.
no. Mock would be your. It is not as in subjective. It's not be objective. It would be subjective only, because you're going to explain things. So, so if we make it objective, like then it is more like it is like your same thing which you are doing the quiz and assessment and all. It is same. So the idea of a mock is to prepare you for the real interviews.
this is going to be 2 weeks from now.
Yeah,
This is going to be 2 weeks from now.
yeah. 2 weeks you can say 2 weeks. Yeah, right. So once we are through with the derivative chapter, as in we are left with two chapters in derivative. One is your option partly we have done, so we are left with part of it only. And then we will be doing the swap, and thereafter the mock would be there. So you can say about 2 weeks time. Okay, Sana.
Yes, sir.
Okay, so hope it is clear. It is not going to be objective. It is going to be subjective, like a interview only. You can take
Cool,
it
sir.
like when you go
Understood.
for, yeah, it's that way it would be. Yeah. Mm, okay. Any other question before we guys close it for today? So we
Sir,
have.
sir, I've started using this app called Stock Trainer. It's stock trading app. It's a virtual app with which I can do the trading part. So I've just started it. So I just wanted to share it. So everyone else can download this app if they
That's
want
really
to.
great.
Uh,
Maybe that's really
can you
good.
share the name of the app over the chat
Uh,
if
yeah, sure,
possible?
sure. It's called stock
Uh,
trading app. So they will give you some virtual money with which you can do the trading. I'm writing it down on the chat box.
Okay,
okay.
that's
Thank you
really
so
good.
much.
So
That's
there's also one called Dalal Street.
uh,
I think it's for NSC. You can
okay,
do trade also on that if you want
okay,
to.
and that is also virtual, right?
Yeah, yeah.
Okay,
It
that's
is.
really good. Okay, good. So I would encourage all the people, especially those who are not into trading. I know Nishant and Chunky, Akash, you guys are doing trading and all, so you would be more familiar with all those things. But people who are not into trading, probably they can take some of flavor with the help of virtual app also. also, because it is going to work in a very similar way, I am sure. So that way, even without being connected directly with the with your with the
I
live as in the real trading app, you can take a flavor of this trading and all, and that way you can probably gain more
so
knowledge also. Yeah.
one more thing. Actually, the app that he's selling, stock trainer, stock spinner,
Hmm.
these are the app for forex market, I guess. It is not for the equity share. Is it
Yeah.
right or wrong?
Okay. Then use Dalal Street. No, Dalal Street have, I think, Indian companies.
Okay.
Okay.
Okay,
Okay.
Dalal Street. So let me just
Okay.
write it. Okay, so that one for equity, right? So okay, that's a good one. So maybe we can download both of them and check which is best, and accordingly use. If it is for the FX and you want to have a probably exposure to equity, then use this one which Nishant is suggesting, and it can help us, right? So that's it, guys, for today, and then next weekend we'll start with derivative where we left it, and we'll complete that. Okay, till then, take care, stay safe, and bye. See you.
Thank you, sir.
Bye bye. Yeah,
Thank
welcome.
you, sir.
Welcome. Bye bye.
Thank you, sir.